Welcome to the main stage of the SOSV Climate Tech Summit, Day 2. If you're watching me now, you're in the right place to see the second of 2 days of interviews with many of the founders and investors inventing and financing the decarbonization of our precious planet Earth. In case we didn't already meet yesterday, my name is Sean O'Sullivan, and I am the founding and managing general partner of SOSV, which is the host of this event. SOSV is a multi-stage global venture capital firm. We invest from inception, meaning right at the very start of a new company's existence, in companies whose technology will improve human and planetary health. SOSV is one of the world's leading climate tech investors, and we have more than 150 climate tech firms in our portfolio. The co-investors in our portfolio companies include virtually every climate tech investor in the world, from DCVC and Coastal Ventures to Temasek and Breakthrough Energy. Many of them are partners in this summit. I'm speaking to you from SOSV's New York City facility, which overlooks Penn Station in Manhattan. I will be introducing sessions with the help of my SOSV colleagues here, as well as at SOSV's other labs and deep tech workshops in Newark, New Jersey, and San Francisco. Along the way, we'll tell you a bit about the incredible lab and engineering spaces and the people who work at SOSV. To finish introducing the summit, I'll turn the floor over to my colleague, Dr. Sabria Stukes, who you met yesterday. Hey, Sabria.
Thanks, Sean.
Thanks.
Day 2 of the summit.
Yay, let's do it.
Let me quickly get our attendees this morning oriented. Today, October 17th, is our second and final day of main stage programming. These sessions have all been pre-recorded, and anyone can view the stream during these hours. Also, it's completely free. You can send or post the link to this page anywhere, and people can join in real time. It's wide open. After the event, on or before October 19th, all of these sessions will be posted in a YouTube archive. Everyone who's registered for the event will receive an email with those links. So in other words, whatever you missed today, you can watch later, whenever you want. The second part of our summit circus is what we call the breakout sessions. These are live sessions hosted by various partners and include many of the top names in climate tech. These actually started on Monday, October 14th, and will continue for the rest of the week. They're listed on the top of the agenda page. The third part of the summit is the VC Founder Matchup, which runs all this week. You can learn more about it on this site, just by looking for Matchup in the navigation. Now, let me introduce our first session. Growth investors backed off, but what will bring them back? Like every other stage of climate investing, the growth stage declined in the first half of 2024. Down by 33% with 13% fewer deals, according to our friends at Sightline Climate. And on the face of it, that's a surprise considering the rapid progress of key firms across so many categories, many with powerful tailwinds thanks to the IRA and other factors. Still, founders want to know, what are the goalposts big check writers have in mind? And what plays should founders run to score those big rounds? For this discussion with 3 eminent investors, we are delighted to have Ali Garfinkel as our moderator. Ali is a senior finance reporter at Fortune and author of the Fortune's Daily Deals newsletter. Over to you, Ali.
Thank you, SOSV. I'm Ali Garfinkel, and I am so excited to be here. Emmanuel, Scott, Katie, I am thrilled to be here with you.
Great to be here as well.
Great to be here. I'd love to ask all of you, what stage are you investing at, and what are you looking for? Emmanuel, start us off.
Look, at KKR, with this the new climate strategy that we are launching now, we try to address the missing middle, right? So in private capital deployment, there is a lot of money going to traditional renewables, usually addressed by large infrastructure funds. And then you have climate tech with a very rich and vibrant ecosystem of early stage investors. Now, when companies graduate from that ecosystem, they usually start needing a lot of capital. So this is where we think KKR can be relevant.
What about you, Katie?
I invest early stage, so I run the Engine Ventures, and we look for breakthrough technology where much of the science has been proven, but you have to scale up. And we look at all forms of climate and adaptation, mitigation, power, decarb, etc. So many areas. So seed through the B round.
Scott.
Yeah, Decarbonization Partners is a joint venture between BlackRock and Temasek, focused on late venture and early growth stage investments in companies with proven technology and what we like to call desperate customers for solutions and technologies that are helping to decarbonize the global economy.
It's not a secret, but there's been a slowdown in climate tech investing. How are you navigating the slowdown? Emmanuel, I'd love for you to start.
Well, frankly speaking, we don't really see a slowdown because at KKR, what we try to do is to precisely add to the capital formation stack what is probably missing and what has triggered the slowdown. That is, when companies graduate from climate tech, from clean tech, because climate is inherently capital intensive, you have to use a different recipe than the one you would use in SaaS or in anything that is asset light or pure tech. You have to put a lot of capital. And this is what was missing. This is what we are doing. So actually for us, we see kind of an acceleration because the companies which are graduating from that climate tech, and now a lot of those are actually coming to us.
What about you, Katie? Do you see a slowdown or an acceleration?
I mean, I think it is a story of have and have nots. I do very early stage investing, right? Seed through really the B round. And you certainly saw a little bit of a slowdown as everyone is trying to figure out how do we value these things. But many things are accelerating. And the rate of change and invention that we see has not slowed down at all. So depends what you're talking about.
What about you, Scott?
Yeah, I would agree exactly with Katie. I think it's increasingly a bifurcated market with companies that have still attractive value propositions and strong investor bases where, maybe it's taking them a little bit longer to get to their next major milestone and they're kind of weathering through this period. But, it is tougher for some other businesses out there. But I think we're definitely still seeing the quality companies continue to get funded, and frankly, those rounds still be competitive at that. So I think there's certainly very strong bright spots amongst the broader market backdrop.
I'd love to dig into this point about this sort of bifurcating market because we're seeing it all over in venture and growth stage investing. What are some recent examples of companies that you all have invested in that you think are sort of beating the trend or on trend, depending on what you see when you look at the data?
Wait, Allie, before we start there, let me just say, this is how venture works. Some make it, some don't. We always run it as a new story. It's not a new story at all. You start from seed all the way through public companies. There are cliffs in every single stage, and that is the form of capitalism we run. And so, nothing has really changed there. I think what is really interesting in this form of energy transition, or however you want to dub this, adaptation, there's all different forms of kind of climate investing. But I think what's changed so rapidly is we all have a much firmer grasp on what it will take to be a global company because we've seen multiple rounds of this and what it actually takes on margins, on growth, on, your techno-economics. I think that's the really interesting moment we have. And every time we lose grasp of those set of variables, we get ourselves in trouble and a bunch of stupid companies get funded and then they fall apart. That's just what happens. And, so you're just going to see that and you see it in every form of tech. This isn't different for climate. It's just that it's more capital intensive than others.
Just 3 points to reinforce what Katie just said. So first, in this sector, like in every other sector, it takes time to go from the very early stages to really graduate from the VC and growth equity landscape, right? And overnight success usually has been 7 or 8 years in the making, right? And there's no exception. It's not different here. It's not longer or shorter here. It's just the same. 7 years is usually what it takes to to figure out that, oh, this is a thing that's new. No, it's been in the making for 7 years. So that's point one. Point two, I think in this second wave of innovation around climate tech, the one that we saw from 2019 to 2021, there was a lot of enthusiasm. There was a lot of ambitions. It's hard. It's about science. It's about industrialization. It's about rethinking and redesigning supply chains for energy, for transportation, for food, for buildings, for heavy industry. It's hard. So and science and the reality of large scale manufacturing or infrastructure, well, pretty stable. So that's the second point. It's hard. So yeah. So it's normal that we have that bifurcation on that haves and have not, because some people do it better than others at that game of applying science and industrialization practice or scale up, and whereas others are probably less skilled at this. And then the third thing, and this is the difference between this sector and I would say the last 35 years of tech we've been used to. This is not a world where an entrepreneur can say, oh, I've done my series D or F, I'm cash flow positive, don't need to raise money anymore, next stage, the IPO. That doesn't work like this here. That story works in asset light, when scaling up doesn't require meaningful amounts of capital, which is the case in SaaS, in artificial intelligence, in everything tech. Here, usually when you get to that point, you've done your series F, you're cash flow positive, you probably need a couple of billions to continue. And that cash flow that's trickling down your bottom line is not going to give you those 2 billions, at least not for the next 25 years. So you need to continue raising money, but a bit more thoughtfully, a bit differently than what you were doing. And there are a few examples of companies who come to that stage, understand that they still have to raise money, but they still try to do it the same way they were doing it in their Series A. This is where there's a bit of a mismatch sometimes.
I'm still going to make you all tell me about a recent investment, and I don't know if any. Don't worry, I haven't forgotten. And to be clear, I don't think anyone would argue that the roller coaster, the booms and busts, the bifurcation is I think it's a feature rather than a bug. What are going to be some of the characteristics of companies that make it through this period, do you think, in climate tech?
I think, it's all really about execution and discipline. These companies, they've grown up again in an environment where cash didn't have a significant cost to it. And so growth was often prioritized at the expense of, taking very deliberate steps and proving something works at a particular scale before moving on to the next. And so I think those companies that can really just show that they're operationally excellent and hit their milestones using the cash that they said it would take them to get to those milestones, those are going to be the ones that ultimately are able to raise financing and build successful and scalable businesses.
The other thing I would add to this is that, again, we have to move away from, I don't know, the happy dream of what worked well in asset light and tech. This is different. This is about creating infrastructure and large-scale manufacturing. So going public, there's nothing magic about it. It's actually, in most cases, it's actually a very bad idea. And it's very hard, right? So in climate tech, yeah, there is one Tesla, there is one Rivian. That's it. And I'm not sure there is space for anyone else. But going public and look at what those two companies have gone through, and they are not completely out of the woods, especially for Rivian. They will be successful for sure, but there's nothing magic about doing an IPO. Going public, the public equity is probably the most risk-averse, the most volatile, the most impatient type of capital you can get when you're in that stage. So staying private for longer, assuming that maybe your final exit at several billions is going to be selling to a corporate or being in an infrastructure fund. There's no shame about this. So there's also that thing that people have to realize, and that will be different. If you're making components for batteries, if you're making hydrogen, if you're making if you do carbon credits, things. This doing an IPO is probably a really bad idea, at least in the next 15 years. Private capital is going to be there to support you for a longer period of time, and you can probably make better returns, have more patient capital than if you try to do public. Yeah, you won't be ringing the bell on Wall Street, but that's something else. If it's about the ego of the CEO, that's a different story.
Yeah, I would just add, Alexandra, that there are many forms of capital, right? There's private equity capital. There are very long-term pools of capital, whether it's sovereign or family offices that want to see compounding value creation over a long period of time. So the public markets aren't always the best place for that. And I think if you're the entrepreneur, you have to be incredibly, you have to understand what that will mean, right? We had this whole era of the SPAC, which we're going to argue for a long time, was that good or bad? There were certainly winners and losers in that. Some people got capital, but put a lot of pressure on themselves to be public, and some of those went really, really badly. I don't think we're going to see a resurgence of that anytime soon, but I think there are multiple ways to run this, and sometimes being a public company is the right thing if you have very steady offtake agreements and lots of them, very diverse. Maybe that is a good, that is good, and your margins are good. You know, being a public company might be the right thing. It might not be. So I think it is. There's not one use case for all of this, and I think the diversity of capital is the most important thing, with different ways to think about it and different ways to grow the company in the future.
What about for you, Scott? Where do you sort of stand on what exits can look like in climate tech?
I think companies that are ultimately able to put themselves in a position where they have optionality and can, as much as possible, control their own destiny, meaning if they're in a position where they're profitable and have good ability to forecast, they might decide an IPO is the right path, or they might decide that staying private is the right path. And so ultimately, I think not kind of tying yourself to this is the only scenario that can potentially work for us, and we're going to do an IPO or die trying. I think ultimately that's what we seek to find in all of our portfolio companies, and how we think about positioning themselves. I think, to Emmanuel's point, staying private offers a lot of advantages, and many companies don't realize just how intense the scrutiny and the quarterly reporting cycle and all of the regulatory burden becomes once you become public. And so it's hard to go back from there if you take that step. So I think companies certainly should seek to stay private for as long as they can before it becomes untenable for whatever reason. And you have examples of companies that are worth hundreds of billions of dollars today that are still private.
I'd love to get specific about sectors with you all. What sectors to you all right now look the most promising?
Well, for us, again, we come when growth equity cannot follow anymore, where it's becoming too big for growth equity, and where yet it's still too early for infrastructure or for other forms of capital, right? So it's a mix of risk appetite for growth, but with very large equity commitments, like in several hundreds of millions and sometimes in billions. So when you reach that point, there's no technology risk anymore. Business models are proven. There's visibility to cash flows. There's real assets. There's some form of downside protection somewhere. So you start thinking a bit like an infrastructure investor, even though it's not completely infrastructure. So if you look at the categories in climate, which are at that stage right now, I would say there's everything batteries. Deploying batteries on the grid with a high penetration of renewables, making batteries for electric vehicles, manufacturing batteries, and the supply chain from mining to cell makers, EV charging infrastructure, some applications of green molecules, green steel, green ammonia, displacing gray hydrogen, replacing it by green hydrogen in refining and other chemical processes. This is what we are focusing on because all those categories are in at that stage of maturity and that stage of need of capital, right? So I think the thing we are doing the most these days, for instance, is fleet electrification, a bit everywhere in the world, right? Because the economics are really good. It's just about spinning a model that has proven that is stable and can grow, and where you can really create a very strong alpha just by transitioning a fleet of diesel vehicles to electric. And things like this. Now, the logic of what we do is that there are other things which are still in earlier stage, and this is why with decarb partners, for instance, we interact all the time, because whatever they're working on today is going to come to this zone in 2 or 3 years from now, and so let's say that their winners are going to work downstream to them, right? So that's so this is why we're focusing on those sectors because of the nature of our investment mandate.
It's a nice segue, I think, into our strategy because we were investing in battery materials, battery manufacturing technologies 1 to 2 years ago, and I think they are starting to move into that phase where, as Emmanuel made sense, they're starting to look more like infrastructure. They're maybe still on that edge, but the technologies are de-risked, the market is there. And really now it's more about a scaling game. And, one other sector I'm very excited about right now, I think, probably because of the work that funds like Katie's have done in de-risking technologies and getting them up the adoption curve is industrial decarbonization. We're seeing, a lot of really interesting solutions in what's conventionally thought of as a hard to decarbonize sector where some of them, we have an investment in Tora Energy, for example, which is leveraging the great growth in wind and solar to decarbonize industrial facilities with renewable energy that would otherwise go to waste. We have another portfolio company that's leveraging all the great advancements in AI to reduce energy use in factories called Guidewheel. And so we think that there's a lot of actually easier than people think areas of industrial production that we can decarbonize with solutions that are ready to be scaled right now. And hopefully in a year or two, they'll be ready to move into Emmanuel's wheelhouse.
Do you want me to answer that too, Alexandra?
I do. I absolutely love that. Go ahead.
Yes. So there's, since I play earlier, I think there's some really interesting things coming down in new energy generation that are going to be large, clean, firm power that are going to be super interesting, whether it is nuclear, whether it's fusion, whether it's very large, large scale, deep geothermal. All those are coming. And these guys, I think, are going to love those investments when they do, because long offtake agreements and stability. That they're also, I think, will appeal to anyone who's in the White House for obvious reasons of geopolitical stability. Then I think all the decarb stuff of heavy industry, new forms of fuel, these all are breakthrough areas that I think are, in Emmanuel's 7 to 9 year cycle, we're 4 or 5 years into those things. So there's going to be some really good stuff there. And then I would say in all of the built environment, things like HVAC, heat, large industrial heat pumps, all those things are really coming. And if you look at, how much temperature is going to rise, those are going to be a real necessity. I could go on for like an hour, so I'll shut up there. But I think there are so many interesting things. Not all of them will get to the point where we think they should scale and have the ability to do that, but a bunch will. And so this force of good in climate, I think, has a very long life cycle.
And the thing I think what that says is that, so basically to decarbonize the economy, you need 12, 15 technologies, right? So And as they mature and they go through the funnel of early stage, late stage, growth equity, pre-infra and full infra. So that's we are building, all of us, that conveyor belt, if you will, right? So because today out of those 12 or 15 technologies, there is one that is in the money, that is fully mature, that's solar. So solar photovoltaic, super mature, probably more than $300 billion of dry powder in many infrastructure funds. And infrastructure funds love that. Okay, so mature, done. The next thing that's probably going to go that way is what I was saying. So everything batteries, electric vehicle, making batteries and all that. So all that stuff will probably end up in infrastructure funds in 10 years from now or less than this. And then the rest is coming, right? So you have that notion of conveyor belt that Katie, Scott, and I are working. And then at each time, so as those technologies mature and grow, well, we pick them up and then we deliver them to the next stage.
We're coming down the pike here, but in proof that I won't let anything go, I'd love to hear about a recent investment from each of you really quickly, just a couple of sentences about why you made it and why you're excited about it. Who should I pick on first? You know, Scott, you were just talking. Tell me about one recent investment that you really think represents where climate tech is headed.
We recently invested in a Swiss company called Neustark, which is a carbon dioxide logistics and sequestration platform that helps connect small-scale sources of CO2 emissions with concrete recyclers to permanently sequester the CO2 in that concrete using their proprietary mineralization equipment. And it's really just a fantastic value proposition for these small sources of CO2 like biogas plants who don't otherwise have any way of getting value for that CO2. And it allows these concrete recyclers to actually improve their margins meaningfully in what's a low margin business. And ultimately, you know, one of the most scaled solutions globally in terms of actually delivering sequestered emissions and delivering carbon credits with companies like Microsoft and UBS as customers. So that's a recent one that we're very excited about.
Emmanuel?
I would mention Zenobē. So Zenobē is a British company that does fleet electrification. Right? So we're electrifying mass transit buses in London and other large British cities. When you have to transition your fleet of buses or delivery trucks or school buses, it's hard. It's not just removing a diesel vehicle, putting an electric one, a charger on the wall, and off you go. You have to strategize properly. You have to understand which line you're going to transition first. You have to size properly the battery that you're going to use for that vehicle. If your vehicle is going for 200 miles per day, don't put a 400-mile battery on it. And then you have to build the charging infrastructure. And guess what? You're in an urban environment. There is never enough power on the grid to charge all the vehicles you would need to charge at the same time. So what we do with Zenobē, we just solve all that problem for the bus operators in London, in other cities, by telling them, look, you're going to have your 200 buses fully charged, ready to go every morning. We take care of all the rest. And it's going to cost you less than running a diesel fleet, because now everybody knows that the total cost of ownership of an electric fleet is lower than the one of a diesel fleet. You just have to organize the economics and the business model properly to do this. So we are very excited about this. That company started in London, in other cities. Now we are launching it in Australia, in Belgium, and starting to tackle probably the most important problem in fleet electrification in the US, which are school buses. Right, 600,000 school buses in the US. Not many of them are electric yet. So really like this, and really excited about the growth prospects of that business.
We're just about at time. So Katie, I'm going to give you the final word. You can tell us about a portfolio company, or I'll let you off the hook if there's a message you'd like to leave our audience with.
I would just say, I could give you a whole bunch. I'm an early stage investor, so we do 8 to 10 investments a year, and there is so many exciting things coming down the pike. And but I'm so happy to have had this conversation, because I think there is a very thoughtful later stage investment community that we just sometimes talk past each other. And when we actually sit down and listen, I think we all share this excitement for what's coming and what is true energy transition. So thank you so much for having me.
Thank you so much. Thank you all for doing this.
Thanks, Ali. That was a great session, and it was fascinating to hear the interplay of Katie, Scott, and Emmanuel. Let's hope the discussion helped everyone get that late-stage capital back on track. Introducing our next session is Celine Altanach, who is an investment analyst at our New York City location. She works on diligence for both new and follow-on investments. Celine has a PhD in pharmacology from the University of North Carolina at Chapel Hill. Celine, welcome. This is your first year at SOSV.
Yes.
How is it going so far?
It's been amazing being at the front line of the cutting edge science and helping companies help our planet has been absolutely satisfactory for me.
Yeah, it's very, very satisfying to work with these spectacular founders. Well, I'll leave you to introduce the next session. Thanks so much.
Thank you, Sean. This next session is really intriguing. We've headlined it, Blitz Funding, raise like our world depends on it. Growth investors may have slowed the pace, but a few startups have nonetheless succeeded in raising huge rounds, clearly designed to vault them very quickly into meaningful commercial deployment. Taken together, the founders at geothermal power leader Fervo Energy, home heat pump champion Era, and industrial heat innovator Antora have raised more than $1.1 billion in little more than 4 years. By VC standards, that's blitz funding at the outer limit. To have an impact on global warming, this may be what it takes. Now we're going to find out how they did it. To moderate this session, we enlisted my colleague Ben Joff, who is an SOSV partner and the co-producer of the summit. Over to you, Ben.
For today's session focused on Blitz funding, I have three fantastic speakers who have started companies in climate tech that managed to raise large amount of capital in a relatively short time. So first, I noticed that all three of you are engineers and have founded companies in the energy sector that have raised hundreds of millions. Andrew, at Antora, you worked on thermal batteries to make solar and wind usable by industry. Tim, at Fervo, where you work on enhanced geothermal systems using proven technologies such as horizontal drilling to unlock the potential of geothermal energy. And Martin at IRA works on residential heat pumps, taking the Nordic experience to the rest of Europe and beyond. So thanks for being with us today. And I'd like to get the discussion started by asking you, what came first? Is it that you identify your technology, or is it that you identify your market opportunity? And I'd like to start the conversation with Andrew.
Sure. Well, thanks so much. It's great to be here. At Antora, our answer would actually be neither. We really started with climate impact. So we looked at lots of different areas of the climate change problem. We found that renewables were, especially very renewables like solar and wind, were progressing very rapidly. We saw an opportunity there, but we weren't quite sure which area those were going to be best applied to reduce emissions. After a lot of work in the area early on, we found that industrial emissions were one of the best targets. So I guess to some extent you could say the market opportunity came first, but we really think about it as the carbon opportunity that came first.
Excellent. So Tim, I know you have a background in oil and gas. How did you switch to work from oil and gas to geothermal? How did the idea come about?
I actually started my career, as you mentioned, in the oil and gas industry, and I was working as a drilling engineer. And one of my first jobs, I was working in a formation called the Eagle Ford Shale in South Texas, which was right when, the shale oil and gas boom was taking off. And it's actually, for an oil and gas basin, a relatively higher temperature reservoir. So I was doing research on how to deal with the fact that our tools were failing because of how tight temperature the reservoir is. And all the papers that I found were about geothermal. That's where all the research and literature on high temperature drilling had been developed. And I'd never heard of geothermal at that point in time. I kept reading about it and basically learned that it was this resource that, could produce 24/7 carbon-free energy, but had been historically limited because drilling costs were too high. And for me, the light bulb went off immediately because I was working at this new in this new energy revolution where the oil and gas sector in the United States was growing rapidly, really because of the advent of major technology breakthroughs that lowered the cost of drilling. And I realized that there was a big opportunity to apply things like horizontal drilling to geothermal to make a big difference. And so I became obsessed with that idea, and that was over a decade ago. And that's been kind of the guiding principle of how Fervo's operated since then was, how can we adapt these technology breakthroughs to unlock a new carbon-free energy resource? And that's where really the origin of the company came from.
Excellent. So I can see the logic there, and that actually makes me turn to Martin, because in your case, you have started various companies in media and in telecommunications, and you also work for various large groups, including mobility. So how did you go from that to residential heat pumps?
Yeah, I think it's very simple. I like to build and start things. It seems to be a common theme, and it's really interesting to hear you, Tim. I mean, we are really in the same business. What AIR is all about is that we want people in Europe to replace dirty and highly inefficient oil and gas boilers with intelligent electrical heat pumps where you extract the energy from the outdoor air. And I'm coming from Sweden, where actually around 60% of all households are using one way or the other a heat pump for heating their buildings. And many use geothermal energy, especially in the northern part of Europe. And the penetration is 60% in Scandinavia doing this, while in the continental, all other parts of Europe, it's between 1 and maybe 3-5% penetration so far. And this is by far the most scalable and economic way for European households to reduce their carbon footprint. And it will actually save people money, give them better indoor comfort, and it is something that is readily available for everyone. So with that in mind, 60% penetration, we were looking at the opportunity for the climate, and that coincided super well with a massive market opportunity, replacing basically every single household in Europe, detached home, which is 50% of all homes. They still use oil and gas. So I think the market opportunity was our starting point. And we asked ourselves, why this technology is widely available, why isn't anyone doing anything about it? I think that was our starting point for the company.
Actually, I'd like to stay with you for a minute, Martin, because I live in Southern Europe, and my electricity bill is not so nice in the summer and the winter. So I'd ask the question, why aren't heat pumps more prevalent in southern regions? Is it something just suitable for very cold climates? And what did you do different from competitors to believe that you could enter those markets that are not traditionally interested in heat pumps?
Well, I think there has been it's a lack of awareness among people. And I think it's driven by artificially low oil and gas prices historically. I mean, I can take an example take the UK, for example, in Europe, where the environmental tax on electricity is higher than the gas price itself. So, that doesn't foster the right behavior. But I think with rising cost of living, general sense of urgency for the climate, and now also from you can say from a policy standpoint, energy security in Europe, reducing the dependency on imported oil and gas, I think there are strong tailwinds. So you see that subsidies are coming in place, and that was what happened in Scandinavia. Carbon taxes and modest subsidies really made a difference in educating consumers. Because the fact is, regardless where you live in Europe, this is a cheaper and better option for consumers, but people are completely unaware. So when we make a consumer research, 1 of 10 people have even heard about the heat pump, and even fewer knew or know what it is. So I think that's an important reason for it. Lack of financial incentives and lack of knowledge. And I think all of that is now changing. And the way we approach it, because as I say, there are many great product companies out there today, and still we don't seem to be able to make more than 1 to 5% of the population to adapt and these products. And our view is that the value chain is very fragmented, highly inefficient, and there is no one who provides a hassle-free customer journey, guiding the customer from the very beginning throughout the lifetime. So someone dubbed us, the Spotify of heat pumps. So what we want to do is make that same smooth customer experience, but also I think one big hurdle is that there's a high upfront cost. It's probably, between 15 and 30,000 euro you have to pay as a consumer. So what we have introduced is a monthly payment model, meaning that no upfront cost and you start saving money from the very first day. And I think this is not high tech in a way. This is readily available technology, but you need to make it affordable and accessible to many more homes in a different way.
Excellent. Yeah, the Spotify of heat pumps. That's an interesting tagline. And it's very particular to find climate tech companies outside of EVs or maybe HVAC related in the consumer space. So I'd like to move to Tim, because Martin was saying that you're sort of in the same business, because you're also in the business of drilling, except you're drilling kind of differently. And I'd like to ask you the same question, like what differentiates your technology from what others are doing? And what are you'd say that you mentioned that the technologies that you're using are reasonably mature in the oil and gas industry. So what are the risks associated with the deployment of your technology?
Yeah, it's a great question. And I could say geothermal captures a very broad set of technology solutions that are all very important for the energy transition. But what Fervo does is specifically utility scale power generation from geothermal. So we drill quite deep. And actually, that's a big part of what's novel about our approach is we've developed new drilling innovations, in a lot of cases adapting oil and gas drilling technology to work in more geothermal environments to allow us to drill a lot deeper and a lot cheaper. So the category of what we're in is enhanced geothermal systems. That's been something that's been tinkered around with from an R&D standpoint ever since the 1970s here in the United States, when Los Alamos National Lab led a big effort on enhanced geothermal systems, but it always fell short of reaching the right commercial targets needed to be financially successful. In order for a geothermal project to work, you've got to be able to drill for a low cost, and you have to be able to produce a lot of megawatt for every well that you drill to really have a business that's cost effective and scalable. And past attempts at enhanced geothermal systems were not successful at doing it. And what we realized is that sort of production per well was really limited by the fact that people were only drilling vertical wells. So a traditional geothermal project found anywhere in the world over the last 50 years might only drill 500 to 1,500 meters in a simple vertical well and sort of hope that they intersect the right geologic conditions to make a project economic. And what we found historically is that that doesn't work all the time. And that's what's kept geothermal to be a very niche resource, where unless you're in Iceland or Northern California or Kenya, you don't have the right geology to make it work. So Fervo realized that if we could make drilling a lot cheaper, we could go way deep. And we also realized that if we drill down and then turn the bit and drill horizontally and do enhanced geothermal systems, drilling horizontally, we actually access so much more resource per well that it shifts the economics quite dramatically. So last year, we brought online the first project that ever uses horizontal drilling for a geothermal system. So we drill about 2,500 meters down, turn horizontally, drill about 1,000 meters in the horizontal direction, and then we connect those wells through a series of fractures and basically turn the subsurface into a giant heat exchanger where we pump cold water down, it comes back up at the reservoir temperature at very high temperatures, and we can use that energy at the surface to generate electricity. And what's unique about our approach is because we're doing the horizontal drilling and engineering the fracture system that we create, we can do it in any geology. So we don't need these really hyper-specific geologies to make geothermal work. So we're able to scale quite dramatically our technology approach. And really the big risks in our pilot project was designed to address it, came down to one, just feasibility. Geothermal drilling, you're drilling in granite instead of these softer shale sedimentary rocks that the oil and gas industry drills in. We're also drilling at way higher temperatures than what the traditional oil and gas industry drills in. So we had to prove that we could make the right modifications and bring the right proprietary solutions to the drilling process so that we could replicate the results of oil and gas drilling, even in much harder rock and higher temperature environments. We've been very successful there. Our very first well we drilled as a company horizontally, we did it in 71 days. And that was a huge accomplishment in terms of driving, proving the feasibility of what can be done. But we haven't stopped there. What we've done over the last year is we've dramatically increased the efficiency of our drilling. So now we're drilling much hotter, deeper wells than other projects. And our new record was 17. So in just 1 year, we've taken our drilling process from 71 days to 17 days. And that's something that really de-risked that kind of technology. So that was what we had to prove in the beginning was, sure, it works in oil and gas. How does it work when you're in an entirely different geologic setting, like what you see in the geothermal world? And at this point in time, part of our success is coming from the fact that we've very definitively proven we can deliver these really high-performance, low-cost drilling results, even in much more challenging geologies that you find in the geothermal industry.
Excellent. It sounds like you made fantastic progress in a very short time. So I'd like now to turn to Andrew. So people may be less familiar with what you're doing at Antora and what thermal batteries are. So can you tell us a bit more how it works and how it differs from the state of the art of what came before Antora came about?
Yeah, absolutely. And you're right. Thermal batteries are a relatively new technology or new area. And it's really been driven by the advent of cheap renewables from things like solar and wind. So what a thermal battery is, very simply, is a way to store thermal energy. But in particular, the way Antora and most of our, I would say, colleagues, but could be competitors, are using them is to take cheap electricity from wind and solar, store it in the form of heat by heating up a cheap material to very high temperatures, and then extracting that heat later on a 24/7 basis to deliver it to an industrial customer that would otherwise be burning fossil fuels to create that heat. So it's a very simple system, not a lot going on in terms of new technology. But again, this sector couldn't exist until you had very, very cheap, clean electrons coming off solar and wind. So just to say a little bit about Antora and how we're different from some of the others in the space, before going into that, I want to say everybody that's working in this space has the same goal, which is to reduce emissions. And so we really think of all of these folks as friendly competitors. Most of the decisions that any one of our companies is going to be making comes at some level down to what materials we're using. So you have to choose at the start what material you want to store the thermal energy in. And at Antora, we chose solid carbon for a few reasons. Solid carbon is a super interesting material thermally, but actually even before that, it's very inexpensive and it's made in massive volume all over the world. It'd be a surprise to most people. It was certainly a surprise to me to learn that solid carbon blocks are the fourth most produced industrial material in the world. So it's cement, steel, aluminum, and then carbon blocks. And the reason why we make tens of millions of metric tons of carbon blocks a year is because they're used in the production process of making steel and aluminum. So there's an existing huge supply chain. The carbon itself is a really useful material. It's very temperature stable, so you can take it up to temperatures over 2,000 degrees Celsius without any sort of degradation, has a very high thermal conductivity. And the reason why that matters is because it allows you to charge a thermal battery made with carbon very quickly. So if you're looking at why we're building the thermal battery in the first place, to take advantage of these cheap renewables, those cheap renewables are not available all of the time. So when the wind is really howling and demand isn't that high or the sun is shining, you need to be able to stuff as much energy as possible into the battery. So having material that heat can move through easily is really important for that. And then finally, just to talk about the energy density of the system. Energy density is something that it just refers to how much energy can you store in a certain amount of material or in a certain amount of space. And a lesson I learned, I had a background coming from the solar industry, is that you can focus on the cost just of your product, but it's often the balance of plant or the balance of system, all of the associated, shipping and concrete and labor and steel at the site that can end up dominating your costs at the end of the day. And so there were other materials that we looked at that had similar costs, but were lower energy density, which means you would just need many times more of these thermal batteries, which, in an initial spreadsheet pass, you might say, why does that matter if the cost is the same? But it's those kind of secondary costs, all of the rest of the system that you have to be really careful for. So that's a few of the things that are different about what we're doing. but they all come back to the choice of material that you start with.
Excellent. Well, that was a very complete description, and I think it's also really interesting to see these type of systems coming to complement intermittent renewable energy sources. So now to go to the core of our panel is about how you all three managed to raise a lot of funding in a relatively short amount of time. So from the description of what you're doing, it sounds great and exciting, but so do many other companies in the climate tech space. So what put you in a position to identify and convince the first investors that signed the initial checks? Let's start with that, maybe with Martin.
Yeah, I think starting point for us, and we have really great diverse base of investors, but we started with a very clear problem. And I think it's an important fact to what we do is that the emissions coming from heating our homes and the domestic hot water is the third largest emitting source in Europe. It represents around 10 to 20% of all emissions in countries across Europe. And we had a very simple solution to solve that. As I said before, take out inefficient and dirty gas boilers, put in an electric heat pump. It works in most households, and you save a lot of money. And overnight, you reduce your CO2 emissions with 75%. If you have any renewable in your electrical grid, you can go up to 100%. So it's very impactful. And I think that was important for us. A simple problem to understand, an available solution here and now. And I think then we put that together with a very clear business logic. But I think our investors, and we're talking about in Europe, just for heat pumps, but all of you others represent super exciting extensions. Clean energy tech is the future for homes. And thermal batteries is, a very important component with that over time. But just heat pumps, it's 150 billion euro market size at least every single year. And I think they like that. But I think they also, understand the strategic relevance of this. And I think important then with that simple picture is that we attracted a very diverse base of investors, from early stage investors to maybe growth investors, and actually also in the V round, what normally would be later stage investors. And I think that helped us very much, giving us stability in the short term, but we also have investors that we feel that will join us on the long term as well. And I think that's quite exciting, but I think very clear problem, solution, and business logic was our key foundation.
Yeah, so I can see like a very enormous market with relatively limited technical risk and a lot of execution and high potential. But in your case, Tim, there was technical risk. You talked about it, and it was kind of adapting and proving that you could actually do what you intended to do, but with a fairly known technology. What is it about the pitch of your company that convinced investors to put so much money into it from early stage to the current stat?
Yeah, I think there's probably two lessons that I've taken from our journey. And I think one is to be pursuing a broad diversity of potential funding sources, because you never know what's going to land, and you want to be able to have a lot of shots on goal. And I think the second is to pay attention to the reasons why people don't want to fund your business and see if there's ways you can address it. And so, on the first point, Fervo was very fortunate in our early days to not just give venture capital funding, but also philanthropic and government and research funding as well. So actually, it's fun being on a panel like this with Andrew, actually, I think maybe 7 years after we first met, because, for example, we were both in the same cohort at the Activate program at the Lawrence Berkeley National Lab. So at that point in time, Fervo hadn't raised any money, but we found that Activate program that provided, scientists who are working on climate-based solutions to really get that kind of startup cash needed to get moving. And within our first year there, we were able to get funding from, on the venture capital side, Breakthrough Energy Ventures, and then on the government funding side from ARPA-E. And we had this sort of mix of impact investing, venture capital, philanthropically funded money to really kind of get us started. So there's just cobbling together a lot of different sources is I think very important to getting a challenging idea off the ground. And the second one, and this is particularly true around venture capital, if you're doing a venture capital round right, you're probably engaging with 50 to 100 or more investors. And ultimately, maybe one or two or three of those investors are actually going to write a check. And that's considered a smashing success, and it's sort of a funny industry where if only 97% of the people you talk to say no instead of 100% of the people, it's a huge success. And so that's sort of the key, is you make sure you have a big funnel. But then we would also pay very particular attention to, why do people say no? And like, to talk about the technical side, for example, people would come back and say, well, granite's a much harder rock. How do you know you can create fractures in granite? Or, a lot of your business model relies on using fiber optic sensing and geothermal, but it's a lot hotter. So how do you even know that works? And so we would pay a lot of attention to those no's, and then design, in a lot of cases, our next step in our technical de-risking roadmap to address the specific concerns that occurred in the diligence process. So, we raised a $10 million round in 2019, and very specifically set up a technical pilot to answer the questions that most often came up in diligence. And then so we went around for our Series B financing 18 months later. We were able to actually go and talk to a lot of the same investors who passed before. And we said, look, these were the reasons you passed before. We've actually matured the technology in a really big way. And, you have these three specific questions, and we now have field data that validates it. And what we found is every single time we did that, it sort of built a track record of success and credibility that we could deliver on it. And people were willing to invest. And what we just found is, the bigger you get and the larger investment you're looking for, especially as you move away from venture into more institutional money, you just find that the barriers of proving that your technology works gets strong. So then, in our most recent round, we kept hearing, like, we'd love to see something with 1,000 hours of field operation history. So we were able to design kind of a pilot that could achieve that milestone. And so it's always listening to what are the big reasons people are saying no, and then creating the right technical and commercial milestones so that you're addressing those questions so you can unlock that next round of capital.
Excellent. Well, that's thanks for those insights. That's actually really, really interesting. And turn to Andrew. Like, was your funding journey anywhere comparable? Like, did you also pay close attention to rejections and reasons for rejection, or was your journey different?
Oh, I absolutely couldn't agree more with a lot of what Tim said. And as Tim mentioned, we've known each other for years, and I think I've certainly learned a lot from watching Tim go through the fundraisers they've gone through. We similarly, used a mix of sources of funding early on. ARPA-E was also a huge supporter of Antora, the California Energy Commission, among others. When it came to venture, though, at the early stage, I think if the venture investors are doing it right, they're really only looking at two things. And certainly that's what we saw at Antora, which is the size of the opportunity, and that could be in carbon terms or in dollar terms, and then the quality of the team. Really early on, the technology is probably going to change around. Things that you think are true are not going to be true a few years from now. But as long as the opportunity is massive and the team is the right team, you're going to be able to work through those problems. So I think that is how Antora was able to attract funding early on, before we had any of the sort of field pilots or manufacturing that we have now to demonstrate the technology. When it comes to later rounds, though, obviously you have to be delivering on what you said you were going to deliver. And that's something that I think we've really seen, both in our company, companies like Tim's versus some others in the field, is that so much of this is built on trust. You see companies that are out there making outrageous claims. A lot of the times, the other entrepreneurs in the space will kind of know those things, and in the short term, sometimes those things seem to pay off. You see a company raise a big round, and you're like, well, I bet we could raise a big round too if we just said that stuff that wasn't true. But the harder approach, which is just always being super consistent, not over promising, being real about the challenges that come ahead. Over time, that builds the trust that allows you to get not just any investor, but also the best investors in the field. I mean, to Tim's point, there are many of our investors now are ones that we talked to over years before they made the first investment, and they saw that what the things we were saying were things that will come true later. That when we were saying we knew something or we didn't know something, that was actually the reality on the ground.
So it's not quite the philosophy of moving fast and breaking things, unless it's maybe a drilling bit for a drilling experiment.
I always see in hard tech, move fast and break things doesn't work. We say move deliberately with the appropriate risk analysis, which may not be as catchy, but as Andrew said, it's the kind of mentality that delivers year-over-year results that build trust in people providing you with capital to try really hard things.
Martin, what about you on the funding journey? What kind of mix of capital did you bring to the company? How did you identify them and convince them?
I think we were at the position where we could be very selective in outreaching. And I think we have a good mix of investors from different geographies where we operate in Europe, including US investors. I think we also had an interesting mix of, as I said, early stage, more growth focused, and also longer term. And I think we went to the market with a very granular business plan, and we made life a bit difficult for us. We say, let's build one of few direct-to-consumer companies in this space. It's a highly underserved industry. And let's also have this high degree of vertical integration. Develop, manufacture, sell, install, finance your own products. And I think that was one of the challenges.
This is not the type of model that venture capitalists typically like.
No, I know. And that was one of the questions. And we were too young. We worked very fast. And I think management, together with our founder, they put enough money in. And then we work with lightning speed to demonstrate that on each these proof points, build an R&D team, develop the product, that we progressed so well and so fast that it became, easy to understand that the team and what we said was not impossible to do, is something we were moving very, very fast to that target. So I think clear milestones and being able to hit and closing in on those milestones were very instrumental for us. And I think really the team that we had, I think we brought in a pretty senior team with prior experience in every single area. And it really made us able to deliver very, very quickly on those milestones.
Yeah, it's a very good insight as well. Like, I think what I take from what you all said is that identifying the milestones that could actually come from either internal determination or talking with investors or potential funders and partners to identify what is it that they would like to fund is really critical to move forward. And having a speed and momentum to show that you're actually executing correctly on the plan is what builds over time the trust that's required to raise the following round. So we almost have time. So I'd like to get from you all as maybe closing thoughts. Are there any things that you wish you knew and that you wish you had done differently as you built your company? And maybe I'll start with Andrew.
Yeah, I mean, just one thing that I think has changed for us over time is our level of optimism. This has been a long journey, but I think I found that the closer people get to those that are in the trenches working on these problems, the more you see that we have a plethora of solutions, wonderful entrepreneurs and people at all of these companies working on it. And then finally, that this is a really collaborative and supportive ecosystem, and that we're really all on the same team trying to push climate forward. So something I feel like my optimism has just risen over time as I've been in this industry.
Excellent. Tim?
Yeah, I think it's interesting. We started the business. My co-founder and I were both coming from a technical background, and I don't know if we appropriately appreciated the power of communications and getting that right, how that would feed into the business. So I think one of the mistakes we made early on is, we just kind of figured, okay, let's get customers and let's make sure the technology works and everything else will fall into place. And what we've learned after a while is that there's such a massive ecosystem of people who need to believe in your approach and believe in your technology for you to move forward, that you've got to be relentlessly communicating that across a broad stakeholder set. So in the beginning, for example, we weren't really engaging a lot with outside engineering firms because we had great engineering in-house and felt like we could move forward with our own designs. And then you find actually, as you get to these later stages, like those are the groups that all the institutional investors are going to look to say, should we make this investment or not? And so we've been trying to play catch up and bringing that stakeholder group under the hood of showing them how our technology works now. But if we would have thought more deliberately, I think a few years ago about who are the stakeholder groups that matter and how do we make sure we're communicating, what we're doing and the successes we're having to them, I think it would have made things go a lot faster for us.
Yeah, it's probably really difficult for, young entrepreneurs on the new project to understand the entire stack from the get-go. but you've done remarkably well, and your project with Google to provide them with energy has done fantastic. And I know that you're deploying even larger facilities now, and the world needs a lot more energy. So it looks like you have a great future ahead of you. Maybe for final closing words, Martin, what do you wish you knew when you started the company?
No, I think similar to what Tim said. I mean, I'm an operator, and getting into the world working with funding, it's a new thing. And I can just take with me that even if you have a great plan, you're showing the right progress. I personally, I think I underestimated the time and effort it really requires to work with funding topics. And you really want to put all the effort in building the business and focusing on operations and your product development and marketing and the customers. But it takes a lot of time, and your investors are as important as our customers. Otherwise we can't get these companies off the ground. And I think, like in every company, the quality of the team, it really makes a huge difference for us. And having the right team, you can push this forward and navigate these uncharted waters, for us at least, important.
Excellent. So on those hopeful words, I think also I'd like to add that considering the difficulty of the challenges ahead of all climate tech companies, having founders who have healthy dose of naivety is also good because it helps them jump into the fray and not get discouraged as they go. So thank you all for your insights, and off to the rest of the summit. Thank you all.
Thank you.
Thank you. Thank you.
Gerardo, what do you do at Mimic Systems?
We are developing a heat pump without refrigerants. And the way that we do that is by leveraging solid-state technology. Now, the problem with refrigerants is that they are harmful chemicals. They pollute a lot. And so what we are doing is that we are bringing new technology. We use semiconductors to make hot or cold, and we package in a modular way.
I have to say, these look like the most natural-looking air conditioning devices I've ever seen.
It's true, actually. We're paying a lot of attention to celebrate the technology and make it not just more sustainable, but also more beautiful. It's something that I think it's important to celebrate.
When will people be able to get these? Are they mostly being installed into units like commercially, or are you going to make them available to consumers eventually?
We are working on our first big pilot. We are very excited about it. We are targeting the end of the year to deploy, and then hopefully to start launching in 18 to 24 months from now. Ideally, we would like to target initially real estate property managers, and potentially then in the future make it available to consumers.
And where will it first be deployed? In places like New York City and Newark? Or?
We have one pilot in British Columbia, in Vancouver, and we are also in discussion on a pilot in New York City.
Wonderful. Well, great work here. It has a really big environmental impact and global warming reduction. Thanks very much, Gerardo. And back to the program. Over to you, Catherine.
Hi, Sean. Thanks for bringing me on. I'm calling in from our BSL-1 lab in San Francisco. So our next session is called Nuclear Fission, TerraPower's Wyoming Reactor. This is timely given all the incredible news about nuclear power's comeback in the US and elsewhere. Who could have imagined that part of 3 Mile Island would one day power up again? The focus of this session is TerraPower. Just 2 months ago, its lead investor, Bill Gates, was in Kemmerer, Wyoming, to break ground for TerraPower's Natrium nuclear power plant, the first in the US to use liquid sodium as a coolant instead of water, and also the recipient of the largest single federal commitment ever to a private project, 50% of the $4 billion outlay. Here to run what will be a fascinating conversation with TerraPower's CEO is Candice Amori, who is founder and CEO of ClimateVine and a frequent moderator at this summit. Over to you, Candice.
Thank you, SOSV. I'm super happy to be here with Chris Lebec. He is the president and CEO of TerraPower. So, Chris, there's a TerraPower fission plant currently being built as we speak in Wyoming, right? And you all estimate that it could be built for up to $4 billion, and by 2030, which might sound like a lot, right? But it's actually 4 times cheaper and cleaner than any other nuclear reactors recently built in the US in the past. And it's a new technology, right? And so that's what's happening today. And for context, this all started in 2008 when it was TerraPower, the idea was born out of a brainstorming session on how to solve global poverty. So this idea of clean, reliable, and affordable energy was the answer that Bill Gates and team came up with, and TerraPower was born. So my first question, and the first 3 questions will be more contextual, and then we'll go really deep on TerraPower. But my first question is a quick but important contextual question. Why do we even need nuclear as part of the energy mix?
Sure, Candace, it's great to be here today. Thanks, everybody. Why do we need nuclear? I think, well, for sure, we have to recognize that in developed economies and the US and Europe, we've been relying in the US on 20% nuclear for decades. France, more like 80%. And we've seen as we experience different changes on the grid, whether they be short-term weather disturbances, whether they be supply disruptions due to natural gas exports from Russia and Europe kind of dwindling. We keep finding nuclear's more and more valuable. We also have great recognition, growing recognition, really, that nuclear energy is emission-free. So there's actually multiple models now. MIT's done some studies. Energy Northwest, who's our local utility here in the Pacific Northwest, multiple studies showing that the best way to complete an emission-free grid is with 20 to 30% nuclear. In fact, the Energy Northwest study, which was local for us, said that if Energy Northwest and Washington State employed nuclear energy more as we grow demand over the next couple decades, it would save $8 billion. So in a state with about 8 million population, that's $1,000 per citizen. So again, nuclear has just been quietly doing its job for the last 50 years. And now with growing electricity demand, with a lot of your fossil plants retiring, we're really seeing that nuclear is going to have to double or triple between now and 2050 to keep that 30% presence on the grid.
Excellent. Okay, so I think that's fantastic, right? So one, we need more electricity because we're electrifying everything. Data centers are coming online, which we'll cover in a second. And so we need more electricity, period. And we need more reliable electricity, right? Given that climate resilience is more of an issue, and just to run all the things that we want to run, we want it to be reliable. It's a great cost saver as well. And we need to double or triple nuclear in the same way that we need to double or triple energy demand. So is that a fair summary of what you just said?
That's right. That's right, Kid.
Amazing. So basically 6 years ago, we could have looked at nuclear and been like, public opinion would have said, this is unsafe. This is a Republican, preferred power source. But today it's actually very bipartisan. The idea of safety, I think, is still an issue, but I think, public opinion has definitely shifted. There's a lot of money coming from the Biden administration. So you've been TerraPower CEO for that 6 of years, and I think the bulk of that transition actually, in public opinion, in the US at least, has been made. How has it affected maybe your growth or your strategy since you started in 2018 to today?
Yeah, for sure, nuclear is experiencing more bipartisan support than ever, really. If I think back a couple of decades, actually, so I grew up in New Hampshire, and all during my middle school and high school years, I was watching some Democratic leaders, Governor Dukakis in Massachusetts and Senator John Kerry, opposing the opening of a nuclear power station called Seabrook in New Hampshire. So nuclear energy support really fell on partisan lines at that time. And recently I had a chance to catch up with John Kerry, who's now or just recently left the post as the president's climate envoy, and he's totally changed his opinion on nuclear energy. A big supporter now of nuclear. So that's just one example. I think the recognition that again, nuclear energy is not just emission free, but what a great energy security solution nuclear provides is also something that's helped with that bipartisan support. We learned so much that we should have been paying attention to before the Russian invasion of Ukraine. We saw just how compromising it is to be relied on a daily supply of energy from places that you might not trust. And what folks have really realized since the Russian invasion of Ukraine is that when you load nuclear fuel into a reactor, you just loaded 2 years of electricity supply, two winters worth of heating homes. And it's a source of electricity that can't be disrupted by, taking out a rail line or a pipeline. So it's both these energy security and the climate value of nuclear that I think maybe for different folks, there's different reasoning, but for sure we have bipartisan support stronger than ever right now. You're right. It used to be, kind of a Republican supported business, but we're based here in Seattle. We have so many folks of all persuasions who are supporting nuclear. A lot of young liberal folks are really behind nuclear, especially advanced nuclear because of its emission-free characteristics. So yeah, it has been changing over the last maybe 6 to 10 years, I would say, and it's still growing stronger. In a way, you're seeing, both political parties saying, who can do more for nuclear, which is kind of something we've never seen before in nuclear. It's good to see.
Yeah, I'm glad you circled back to John Kerry because I was going to ask how does he feel now? I have a couple follow-ups, but the first question I actually have is you said something about how advanced nuclear is specifically interesting to young liberals because of the emissions-free characteristics. What do you mean by that between advanced nuclear and I guess regular nuclear?
Sure. This gets to innovation and really the reason TerraPower was created. I kind of grew up in the old nuclear industry. I was your, somewhat typical nuclear manager, started out on submarines, worked for some of the big nuclear energy companies. And I would say for the first, 30 years of my career, I grew up in an industry that didn't encourage innovation. I grew up in an industry that encouraged, hey, let's just repeat past performance. When we'd have an outage at a nuclear station, we'd say, let's maybe do 1% better than last time. Because I grew up in a very risk-averse industry, a very regulated industry. And, that was really good for nuclear energy after 3 Mile Island to just focus on predictability, safety, strong economics. But if you have that focus that really almost penalizes innovation, avoids new technology, and you press fast forward for several decades, what you see is pretty old technology. So if you look at, most of the U.S.'s 94 nuclear plants, there's a couple very new ones, but the other 92 are largely, 50-year-old technology, which is what we call light water reactors or generation 2. And you've even seen, because of some of the overregulation in the past, not today, and risk aversion, those owners have been reluctant to employ new technology in those plants. So, if you were to go in a lot of nuclear plants in the U.S. today, you would see analog controls in some control rooms. And you could walk into some coal plants and see that some coal-fired power plants have installed digital controls faster than some nuclear plants have, because we were just, so afraid to do anything new in nuclear. So, when Bill Gates, our founder and chairman, created TerraPower 18 years ago, he knew he wanted to innovate in nuclear. He met with some of the existing nuclear players and decided, and he correctly recognized that, nuclear industry had that culture, and he said, I'm going to have to create a whole new place for innovation in this space, and that's why he decided to create TerraPower. So, honestly, when I joined TerraPower almost 10 years ago, I didn't know what innovation was. What a great experience I had to learn about it from our previous CEO, who's now CTO, John Gilliland. From our young PhDs and even from Bill and our vice chairman, Nathan Merble. It's just been a great opportunity over the last 10 years to kind of bring, the experience and the great execution record of nuclear and kind of combine that with, this innovation mindset. And that's really what's allowed TerraPower to be so successful. Here we are, as you point out, we're the next nuclear power station in the U.S. is going to be a TerraPower technology. So the youngest company in the field is now the leader.
Excellent. Okay, I have many follow-ups, and we have less than 15 minutes left. So I'm gonna do a couple rapid fire questions. One is, what's going on with China? Are they doing next gen? Are they doing Gen 2? I know that they've been building, but what's happening there?
Yeah, China's ahead of us in all respects. They're rapidly growing their new builds. Literally dozens of new builds in progress. So their teams are becoming much more experienced in running these projects on time. And they're doing that with some of the older technology, the light water reactors, but they're moving quickly into advanced technologies too, what they call Generation 4 or advanced nuclear. And they, in fact, have 3 advanced nuclear technologies. A sodium-cooled one, which is like our natrium reactor. It's just not as good as natrium. They also have a molten salt reactor and a high-temperature gas reactor. So, those geopolitics are really important because what we have to realize is nuclear energy will be needed in many nations who don't have it today. So if you think about sub-Saharan Africa, think about Indonesia, places with tremendous population growth, places that will see outpaced economic growth in the next few decades, they will need nuclear energy. And, just like some nations chose to go straight to wireless instead of, copper infrastructure, when those nations enter new nuclear, they're going to want the most advanced technologies. So that's why the U.S. And TerraPower need to be there with Generation 4 technologies, because the Chinese and Russian state-owned companies will be there with the same. So it's so important for the U.S. to be innovating in this space, not just to bring energy security and climate benefits to the U.S. and as we grow demand here due to things like AI, but also we need to think about energy security globally and, providing an American alternative to the Chinese and Russian efforts.
Yeah. Okay. So you touched on a lot, right? One was the company came out of solving global poverty, right? And so being able to spread that to emerging markets is clearly still part of the core thesis. You mentioned that we have 94 nuclear plants in the U.S., but 92 use technology that's at least 50 years old. And we also talked about how today nuclear is less regulated than it was in the past, right? And that's part of the shift and maybe the bipartisan support. Is that all true to say?
Yeah, that's right. And I really do want to call out the efforts at the NRC. We're in an approval process right now for the construction permit for the natrium reactor in Kemmerer, Wyoming. And we've started the non-nuclear construction there, but we have to wait till we have the NRC's nuclear construction license to start the reactor part of the plant. And they've been doing a good job on a review. Of course, they have tough questions. That's their job, but they've committed to complete that review by 2026. And that meets our schedule of loading fuel and making first electricity in 2030. And they've really listened to Congress. Congress has, I mentioned this bipartisan support, a big example of that bipartisan support was a law called NEMA, the Nuclear Energy Innovation and Modernization Act. And that's where both parties in Congress several years ago told the NRC, you must innovate. You must commit to, firm schedules for your regulatory review. And I can really see the NRC, embracing that empowerment from Congress.
Excellent. So something that I have heard is we don't need new innovation. We need to just build better, right? We just need to get used to building so that the cost goes down, right? So we're just not used to building. Or we need SMRs, which are more like manufacturing innovation, not really technical. And so we have 10 minutes left. I want to really go deep on TerraPower, but in like a minute or two, what would you say to those two arguments there?
Yeah, so today's light water reactors are very safe technology. Their construction costs are kind of in the rearview mirror. They've been amortized a long time ago. So those are great, safe operating assets that should continue to run. They should have their lives extended, up to 80 years, who knows, maybe even 100 years. But if we look at building new ones, right, that's a whole different game. It's hugely capital intensive. It's been something that's been really hard to get started in the US and in Europe, right? There's no success examples really of US light water reactor projects that have been, completed on time and on budget. And, this is where innovation comes in. You have to recognize that when you have a 50-year-old technology, you start, you can make kind of incremental improvements to it year after year. But at a certain point, there's no more headroom. There's no more optimization you can make. And that's kind of where light water reactors are today. So when Bill created TerraPower, it was with the idea that we needed to move to a whole new platform, which for us was a sodium cooled reactor that operates at low pressure. We had a more recent innovation where we added built-in energy storage to the plant. And so this platform, the Natrium reactor is so different than the light water reactors, because it's low pressure. It's going to be a much lighter plant, so it's going to use less materials. It'll have less piping, less steel, less concrete. Will require less labor to build. You won't need the very heavy, civil containment of today's reactors. So, we really needed to move to that new technology to lower the capex for these plants, because that's been the hard thing. Running the old reactors, is great because we've already paid for the capex. Some companies went bankrupt doing that. If we're going to build new ones, we really need to move to new technology.
Excellent. And so 3 Mile Island, which you talked about earlier, is reopening, right? They agreed to sell the next 20 years of energy to Microsoft, which is another Bill Gates company, right? So there's sort of this stopgap, is what I'm hearing, until something like TerraPower is ready. And what I also heard was just the cost, right? We have a lighter plant with less labor, fewer materials, which are also, steel, cement, like those things are very carbon intensive. And so, less that we can do that, the better. I want to go into more about the technical innovation. So there's something around, if we think about public opinion, right? One of the big ones is, what do you do with waste in nuclear? It costs way too much, and safety is an issue. And so I think you talked a bit about cost with the lighter plant. And if you want to share anything more about that, that's great. Tell me more about the safety, the waste production, and anything else that's really unique to TerraPower.
Sure.
Yeah.
Sure. Just, briefly on cost, well, you need to realize these first few plants will cost more than the 10th plant. There will be investments you have to make, and, things like getting through the NRC license, things like doing the first design, which for us, is a 1,000-person effort. And you can't tax or form your opinion on the cost of the first, the cost of all plants by what the first one costs. In drug development, a lot of money is spent, to develop a drug that you don't charge to the first patient, right? And we should look at nuclear the same way. So we're fortunate to work for Bill, who's a long haul thinker, who really drives us to think about what's the most economical machine, when we get to the 10th unit or so. So that's just, important to think of in nuclear. So, that's really how we need to think about the economics here.
Excellent. And I think, first of a kind financing is a really big topic in the climate space. And it seems like you all have a little bit of a luxury to think about that 10th unit, given the funding sources, which is fantastic. But also you've had a lot of government help. You've had, other investors come in, different strategics, even from Japan and different places. So that makes a lot of sense on the costs. Let's go into the tech side. And so sodium reactor, safety, waste production, how does it deal with that?
Sure. And you were alluding to waste earlier too. If you're going to talk about waste or use nuclear fuel, you can't help but talk about the great story of today's reactors. So, the 94 reactors we have in the US, about 400 around the world. The used fuel, for sure, it needs special handling. It's hazardous. It needs a final disposal solution. But you have to recognize that the entire used fuel inventory from, our 90 plus reactors in the US that have been powering the country, 20% of our electricity for 50 years, that entire volume, could fit on a football field, like 1 story deep. So is it hazardous? Yes. Is it manageable? Extremely so. And we need the Department of Energy to come up with the final geologic disposal solution, which they're working on. So for Natrium and Generation 4, it really builds on that, that good story. That there's no smokestack at a nuclear plant, right? Do we have waste we need to manage? Yes. It's very dense. It's safe to store until we find the geologic disposal solution. But for Generation 4 reactors like Natrium, we'll generate about 2/3 less waste per gigawatt generated than today's power sources. So it's an improvement on what's already a great story. And I do believe used fuel storage on site is very safe till we get to the geologic disposal, and then when we do identify the geologic disposal location, we've done our own work with MIT that shows, that's very safe as well.
Excellent. So there are maybe 40 other Gen 3, Gen 4 fission companies, right, with different designs, maybe different 1,000-person teams or smaller. I don't know how big all these teams are doing different designs, but you all have, I think, beat all of them on commercialization timeline. How did that happen? How are you all able to do that?
Sure. There are dozens of companies out there, which, we think is a good thing to have lots of ideas. Some won't make it. They all start with kind of single-digit million spending, and then, to get into double digits, requires more serious investors. So it's good to see all those possibilities out there. We've been able to advance into what I call triple-digit spending, right? That's what you need to, sustain a 1,000-person design effort. There's really almost no one who's at that level of commitment. And for us, that's been enabled by super strong private investors like Bill Gates, like SK, the Korean company that joined our last round at $250 million. It's also been enabled by the Advanced Reactor Demonstration Program, a $2 billion grant. I guess one differentiator I wanted to point out here was how we've structured our first project in Wyoming. Some companies have tried to get the first customers to cover too much of that first of a kind investment. And in our mind, it doesn't work because you're asking the wrong people to pay for the first of a kind costs. Just like in pharma, you don't ask that first patient to pay for all the R&D. So the way we look at it is our private investors will get their return when we sell hundreds of Natrium reactors. The U.S. government will get a sovereign return when we reestablish technology leadership over China and Russia, and when we reinvigorate our supply chain, and when we, improve our grid stability with lots of these new units. But the wrong place to put that investment is on the backs of regional ratepayers. So when the folks in Wyoming and Utah, pay their electric bills that has the first natrium electrons coming into their home, it's not going to have anything to do with the first of a kind cost. They're going to pay for the value of the electricity that's determined by the Public Utilities Commission. The value of the electricity, that will be competitive with, natural gas, with solar, wind, and we just feel strongly that's the right way to do our first project.
And so the people that are covering that cost are really the strategic investors and the private investors and the government.
That's right.
Okay.
That's right. Which is, that's structuring that first project is in some cases harder than the technology, because what you're seeing is a lot of folks saying we need nuclear now. Look at the AI demand growth, and you're hearing about the restarts of these plants, which is good, but you have to recognize there's probably only maybe 4 or 5 nuclear restarts, and so that's this many gigawatts when we need this many. So we really need to get into these new builds, and except for TerraPower, you're seeing a lot of people kind of pointing at another group to say, oh, you should make the first funding move. Some are saying, oh, the data centers should pay. Some are saying, let's take a company public and we'll raise money that way. And that hasn't been too successful. There's been some nuclear startups that, haven't raised a lot of money by going public. So, we think we have the right, first unit funding plan, which again relies on our private investors and the U.S. Department of Energy.
Yeah, I mean, I think that's such an important thing to think about in climate tech, that yes, it's the tech. We need good tech and we need really good financing. And without both of those things just don't work out. So I'm super excited, Chris, for 2030 when the first Atrium plant is ready and Wyoming customers can actually purchase from TerraPower. So thank you so much for the work you're doing and for joining us at SOSV.
Thank you, Candace. Thanks, SOSV.
Thanks, Candace and Chris. That was a fascinating discussion. Sodium-cooled reactors certainly are a big improvement in every way over water, but I guess the bigger observation here is let's get more nuclear up and running as fast as we safely can. The stars are finally aligned to bring back one of the safest, cleanest, and most efficient sources of power ever. Now, we're turning to another energy technology that will be one day even better. For our next session, let's bring on Andy Golak. Andy's a partner in Newark, where he runs investment operations for companies entering the Newark program. He also works closely with companies after investment, helping them de-risk their technology, develop scalable go-to-market strategies, and secure additional funding. Andy holds an MBA from Carnegie Mellon and a BS in chemical engineering from Michigan Tech. Andy, good to see you.
Yeah, thanks, Sean.
So what are the kind of technological challenges? What's the range of challenges that HAX helps our startups deal with?
Yeah, our companies come in at various stages, right? So sometimes we start with a robotics company that's just sort of a drawing on a napkin, and we help them take that napkin sketch to something that looks like a proof of concept reality. Or some of our companies have been backed by millions of dollars of non-dilutive funding. They've got great data, proof of concept research, and we help them take that leap from proof of concept to something that looks and starts to mimic more like a commercial, scalable process.
Thanks, Andy. Great work here.
Thanks, Sean. Our next panel is entitled Fusion Energy. How close is close? Nuclear fusion's promise of abundant, low-cost power is the holy grail of the energy sector. But containing the nuclear reactions that power the sun is one of mankind's greatest technical challenges. So how close are we? Commonwealth Fusion Systems, an MIT spinout, has raised $2 billion and built the novel Rebco magnets required to contain superheated fusion reactions in its tokamak donut reactor. Commonwealth has projected that its plant under construction in Massachusetts will be on the grid in the next decade. That's a big commitment. Our moderator for this discussion, with one of the co-founders of Commonwealth, is Allison Snyder, a managing editor at Axios, where she oversees the newsroom's coverage of science, space, and world news.
Thank you. I'm Allison Snyder. I cover science and oversee our world news coverage at Axios. And, fusion is a topic that increasingly comes up in both areas, especially with the field's scientific advances over the past few years. But also, China's increasing capabilities and ambitions in the technology, and all of that against a sort of backdrop of growing energies from big tech, global warming, and the sort of effort to mitigate its effects by producing clean energy. So I'm really excited to talk today with Brandon Sorbaum. He's the co-founder and chief science officer at Commonwealth Fusion Systems. He is the main driver of the company's scientific direction and R&D efforts, and leads the company's efforts to advance the design of their commercial fusion power plant, ARC. Do you call it ARC or ARC?
ARC.
ARC. All right. Yeah. So thank you for taking the time to talk with me today, Brandon.
Yeah, thanks for having me here.
Yeah. So listen, there's been a really dramatic increase in private investment in fusion energy over the past few years. I think somewhere I saw a statistic of about private companies raising, at least $7.1 billion. And then there are public investments too. China outspending the US this year, $1.5 billion to $750 million. So I guess the big question for us today is, will and when will fusion energy change everything and deliver on that investment? So maybe a good place to start is, what's the sort of list of things that has to happen for this to get to commercialization in terms of the actual machines, the systems?
Yeah. So the first thing that has to happen is we've actually already seen the break-even point be demonstrated. A couple of years ago, there was the really exciting announcement from NIF, the National Ignition Facility out in California. And so they showed that you can, they had proof that you can get above a break-even point. And we knew this was possible, theoretically, and this is the first device to do that. But I think the next step is to do that in a commercially relevant device. It doesn't necessarily have to be in a device that is making power going out into the grid, but getting that break-even point, we call it Q greater than 1 for gain, in a commercially relevant device. And so that's what ourselves and several of the other startup companies are aiming for right now, is to build this first sort of demonstration device. And then after that, building the first truly commercial power plant that would be on the grid, putting electrons on the grid that come from the generation of fusion energy.
So just for a second to sort of lay the stage, I guess, what's the sort of broader ecosystem in terms of the number of companies, the different concepts that are out there, just to give us a lay of the land?
Yeah, so it's pretty big. So there's, as far as companies are concerned, it's grown substantially. Like you said, that $7 billion of investment, if you had looked like 5 years ago, it would have been a small fraction of that investment. It's really in sort of the last 5 or 6 years that there's been this growth of in the private sector of companies pursuing all sorts of different concepts on how to get to fusion energy on the grid. And so I actually don't know off the top of my head right now. Feels like there's a new company every month or two, but there's several dozen companies all around the world. Many of them are in the U.S., but this really is like an international thing that's happening. And like you mentioned, so far, just over $7 billion of investment has been raised in the space, which is pretty incredible. And I think that really speaks to the maturity of the technology. And so fusion, if you had asked, maybe 5-10 years ago, who are the players, it would almost entirely be academic labs. It would be big national labs. There's a very large international collaboration called ITER, which is being built in the south of France right now. And that was really the biggest game in town. And now there's a whole bunch of private companies that are aiming to do this in a commercial way, and basically building upon what our strategy is, to really build upon the work at CFS of this concept called a tokamak that most of the world's academic communities have been focused on. So there's other companies out there that are looking at alternate concepts that don't have as much, I would say, there's not as much of a scientific backing in the community, but they're looking at these concepts as a way to maybe try to get something faster and explore unexplored areas of the space, because there's many different ways that you could get to a fusion plasma.
So, but early enough that those are still in the game, right? That those are equally, plausible, possible?
Well, I mean, I'm obviously a little bit biased here. I would say that what differentiates us is that the science that we're building on is, I would say, arguably the most rigorously proven out in the community. But there are other people that are out there, trying other concepts and publishing on their results, and really subjecting them to the rigor that our concept has been subjected to already in the academic community.
Right.
And I think the main point with the startups is that there's this mentality of being able to have very fast cycle times. I mean, it's very traditional startup mindset, but it's being able to fail fast and being able to go in multiple iterations of something. And I think that's really the beauty of this whole startup ecosystem, is that there's people trying a bunch of concepts, and some of them might be very far away, but I think it's good that people are trying things, and putting the results out there so that we can see if something works or not.
So I've often heard it described as it's not so much about whether it will work, but whether it'll be cost effective or cheap enough to actually make a difference on the grid. And so, in other words, the tech might work, science might work, but will the economics? Do you agree with that? Is that a fair assessment of things? I mean, I want to go back
I don't think
some of the technological things too, but yeah.
Yeah, I in my mind, I don't think it's a question of if it will work. It's a question of when it works. And then, like you said, it has to be economic and it has to work for people. And so, again, with our concept, we looked at where the science was going and where things were going, for example, with ITER, which is a very, very large device. And we said, that doesn't really scale to something that looks like it could be economically feasible in today's current environment. And so we said, and all the other startups have basically said, you have to build something that is small enough that you could build this with a single company or a single entity that could build this. And on a time scale, it has to be small and it has to be fast, right? You can't build something that's very large and takes a long time and have that be commercial. For ITER, that's not a problem because it's a science device. And so ITER does not necessarily have a commercial mission. But in order to get fusion energy onto the grid, we do need to get to that step where we are building devices that are small enough that the capital cost of the device is low enough, and that the time to construct is short enough that you could actually make a case for these being economic. And I think we have a really clear path to that. One of the beauties of fusion is that the fuel is effectively free. The fuel is coming from isotopes of hydrogen, one of them that's extremely plentiful, and the other one that you can generate from lithium, basically. And so the feedstock is effectively free, and actually even going a step further than that, you can put all of the fuel basically for the entire lifetime of the plant on site on day one. And so there's not even necessarily like a fuel distribution in steady state. You distribute the fuel to the plant once, and then you start it up. And so that is very, very favorable to your operating economics of the plant. And I think, the name of the game right now is to get the capital costs of the devices down to a point where that also makes sense. And we think we have a pathway to do that with our technology and shrinking the size of the device down to a scale that makes sense. And so, you're building something that's like the capital investment of a natural gas plant, but you don't have to pay. There's not this huge operating cost of paying for this fuel source that has to be, you have to pipe in a ton of fuel, and it doesn't have the negative externality of putting a bunch of carbon into the air.
Right. So you just answered my next question, which was about how small, when you say small, and then, but how fast? How fast are you talking about?
To get to commercialization?
Yeah, what's needed to be able, you say when you have to be able to, yeah.
Well, so we want to get to commercialization by the early 2030s.
Mm-hmm.
I think that's the speed at which we want to do this. And I think in order to, that's like the first plant. And then we need to get this to where you're able to build a plant in 3 to 4 years. So similar time scale as building a natural gas plant, for example, where, you go from getting a site to having something connected to the grid, producing electrons into the grid in 3 or 4 years.
Okay. So in terms of what's needed to actually build these, and sort of the supply chains that are necessary, what I guess, where does it stand today, and where are you headed? And then we can talk about all the things that will take to get there.
Yeah. So the supply chain is a really interesting piece of this. It's there are some specialty components that are in the different concepts. So for example, ours and several other of the startup companies utilize something called a superconductor, which is a material that can pass current through it. It's basically like a very, very good wire for making magnets. And it's a wire that when you get it cold and you pass current through it, it does not heat up. So like a normal wire, like, in an old style, like incandescent light bulb, you put wire through a filament and the filament glows red hot, and that's how you get the light out of it. And any normal metal that you do that to, you'll generate a whole bunch of heat. And so you can't build a conventional magnet that would be anywhere near economically effective on a power plant. You'd basically have to take more energy running your magnets than you would get out of the plant. But if you use superconductors, then there's actually zero resistance that's in a superconductor when it's in its superconducting state. And so there's no power dissipation in the superconductor itself. And that actually makes the magnets, that drops the power consumption to nearly zero. You have like a tiny, tiny bit going into like the leads from your power supply that go into the cryo system of your magnet. But it drops it substantially to the point where basically you can get all of the energy that's being made from fusion and take that and transfer it out into electricity.
Mm-hmm. What are some of the other, I guess, potential uses of take that technology, for example, as it's being developed, or, are there knock-on effects?
Yeah.
Yeah.
So the superconducting wire is really interesting because we use it for magnets, but really you can think of anywhere that you use wire. You could think about replacing it with superconducting wire. So one of the big markets for this that are suppliers of this material is called HTS. I'll try to refer to it as superconductor, which is more general. If I slip and say HTS, that's what that means. Our superconductor suppliers are looking at like transmission markets, because right now transmission lines have these same losses, and there's been an optimization done to try and limit the losses as much as possible. But at the end of the day, there's still a decent amount of loss on transmission lines. And so there's actually startup companies out there right now who are trying to build transmission lines that would be lossless, built out of the same superconducting material that we're using for our magnets. You could imagine this going into MRI magnets. That's another big application that uses magnets. But really, anywhere that you have wires, you could think of like, replacing bus bars inside of factories and things like that. Grid interconnects is another place that's kind of along the same line as power transmission. But there's a whole bunch of uses for these superconductors that are really interesting.
Have there been any spin-offs to date, I guess, from the development of some of these technologies, or not yet?
Yeah. Oh, yeah. I mean, like for the I'll call them out. But there's, just in our area, there's a company that we work with called Veer. That is one of the companies that's working to commercialize this technology into transmission lines. And there's a few other companies that are also looking at this. And one of the things that is really interesting, I think, about fusion is that for these superconductors have not really been, the high temperature ones that we use have not been around for a long time commercially. But people have known about the material itself kind of in like a sort of like a lab scale for 30 years. And so people have dreamt about what we could do with this. And what fusion is doing is it's really an enabling technology for our magnets. And so we took that supply chain, and we're very much driving that supply chain right now to increase their volumes and to decrease their prices. And as we do that, that's opening up all these other markets that maybe would have been, more of a marginal cost increase if there hadn't been someone to take that initial step and say, okay, get the volumes high enough and the price is low enough that you can now start having it be economic to use for other things like transmission lines. There's other people who want to look at using it for motors and generators. If you make the windings of the motors and generators superconducting, you can make them more efficient and weigh less. So yeah, there's some really interesting spin-off technologies that you could get, and we see that sort of around. We're starting to see that in different places around the supply chain, where things that fusion is driving can benefit other industries. And also we see things on the flip side. We see things like like solid state power electronics. Our devices, the tokamak, is basically, it's actually really interesting. The tokamak itself does not have very many moving parts. The tokamak itself is actually, there's no moving parts inside of the tokamak. And you can almost think of it as it's almost like a solid state device in of itself. But the magnets are driven by power supplies that have solid state electronics. There's RF energy that goes in that we actually are using solid state to drive that now instead of tube based. And so that's an example of us taking a technology that was developing elsewhere and incorporating that, taking advantage of those technological trends in the supply chain and using them to ultimately make our device more economic.
Right. Are there, I know earlier we were talking about how there's a couple of different approaches to this. My understanding is that all of them need sort of, technological developments in materials, different types of, parts. Do any of them overlap in the sense that like a material that's built for one approach, is it potentially could be useful in another? Just thinking about that supply chain. Yeah. Okay.
Oh yeah, there's definitely a lot of synergies. I mean, I think in general, having strong structural steels, especially for the companies that make magnets that can operate under cryogenic temperatures very well. That's something that scales. All of these devices, require large machine metal structures. I guess I shouldn't say necessarily it doesn't have to be machined. They require large metal structures. So being able to machine those structures, having the supply base to be able to do that, or maybe in the future, doing more advanced manufacturing techniques to make those structures. That's something I think that benefits the entire industry. For the ones that use magnets, the superconducting supply chain is of course very important. And I think the solid state is another area where advances there would really benefit most of the companies that are building concepts right now.
And so, aside from the supply chain, what about, I guess, talent? How important is there a talent pipeline in terms of not only scientists but also pipe fitters, welders, machinists? And is that an interim need while you're sort of there these bespoke machines and pilots being built, or is it a much broader need for the industry?
I mean, I think it's a long-term it's a long-term thing where we want to build up a talent pipeline. I will say that one of our strategies has been when we design our machines, we try to do it using as little bespoke nature objects as possible, right? Because we want to be able to take advantage of existing, welding capability and pipe fitting and make this thing look as much like a conventional power plant as possible so that you can utilize as much of the existing workforce as possible. And we've actually had, a good example with this is our constructors who are building the tokamak hall. So that's the building that houses Spark, which is before ARC, we're building this device called Spark, which will be the first commercially relevant net energy, but it's not going to put electrons onto the grid. And, the people who are building, the constructors who are building this building for us, it's a somewhat specialized building. You have to have, there's concrete in it, has some special rebar in certain areas. But for the most part, it's a conventional, it's using conventional building using conventional methods. And so we didn't have there's not like a special construction firm that knew how to build tokamaks. We actually partnered with a local constructor, Bond, which we basically sort of taught them how tokamaks work, and they taught us how construction worked. And we were able to get them up to speed very, very quickly to build a structure that suited our needs. And I think, doing that in as many parts of both the infrastructure that you need to run the plant and then the internals of the plant itself is going to be really important so that we can scale this as fast as possible and utilize, like you said, as much of the existing workforce. I do think, that being said, I do want to add that there are, we still would like to see, I would personally love to see more fusion programs in not just graduate studies, but in undergraduate studies, just to get people, familiar with the ideas. And to build that talent pipeline. I do think that, we want to scale the industry exponentially. And so I do think we need to scale, we do need to scale the fundamentals of, the physics behind fusion and things like that in schools. But it's not something where we need to retrain every single aspect of how you build these plants. That's definitely not the goal. The goal is to be able to reuse as much sort of existing knowledge and existing infrastructure as possible. Because it really does come all the way back to economics, like you said at the very beginning.
Right. I've also heard fusion sort of described as being on par with AI in terms of the potential return on investment. So if I might as well ask how the two sort of come together. Are there opportunities for, or are there ways in which AI is already impacting the work that you and the broader sort of ecosystem of fusion energy companies do? Yeah.
I think it's actually, it's twofold. It's impacting us in two different ways. In one of the ways, and I think we're probably just the tip of the iceberg on this. We do use, there are some applications of using AI, like people, this is more in academia right now, but we're reaching out and working with these groups about using AI to basically get a deeper understanding of the physics behind how the plasmas work, and to look at basically predicting events in the plasmas that might cause them to become unstable and disrupt. Not from, and I should add, not from a safety point. So fusion is extremely safe, but if the plasma disrupts, then the plant, there will be a blip in the output. So you don't want that to happen. And so AI is being used. AI techniques are being used to look at making the operation more stable. But I think really more importantly on the other side, I think AI is really affecting fusion because it's driving growth in demand for energy, right? All of these data centers that are powering all of the AI tools that we use are using massive amounts of energy, and all the technology companies that are building these are, they all see that we need to find a way to power these, and it would be really bad if we built a whole bunch more coal power plants to power these AI data centers. We would like to power them with something clean, and I think fusion is a really, really good option for this because unlike solar or wind, which are great in their own right, for a data center, you want 24/7 power. And so if you want 24/7 power with something that's also clean, fusion is one of the few options that you have to be able to do that. And it doesn't have the same safety considerations that you would have with nuclear fission. Which you have to, there's a lot of safety considerations around that. And fusion is inherently safe. And so fusion would be a very good option to be able to, to provide clean power to these data centers in a way that does not, disrupt the environment.
Are there any big tech fusion partnerships that you think are important to watch or that you're aware of?
I think, I think it'll be important to keep an eye on. A while ago there was an announcement. One of the companies in the ecosystem announced an agreement with Microsoft, and I think looking for more things like that, will kind of be a signal that the tech industry and AI is taking a look really seriously at how to actually power these data centers with clean energy.
Mm-hmm. Do you, you just mentioned fission, and I wanted to go back to that actually, because what are the sort of, I guess, regulatory hurdles or considerations that you see, potentially popping up as this progresses? And well, we'll start there.
Yeah. So I think that we definitely looked at regulation and we said, okay, we need to be regulated different from fission, because I guess I should back up. Fusion is inherently safe. When I say that, it's not like, we build something special into the process to make it safe. It is just from a fundamental physics standpoint, fusion is inherently safe because it actually is the fusion reactions that are occurring are actually very fragile. It's why we don't have fusion yet. It's kind of a double-edged sword. You would imagine intuitively that if you're basically creating a star, because stars use fusion, stars are big balls of plasma that have fusion, you would think that it's this big hot thing that's like lava that, if it hits the side of a container, then it would be really bad. But actually, they're very diffuse. And so if you were to lose confinement on your fusion plasma and it drifts and it hits the wall inside of the vacuum chamber that it's in, it extinguishes itself. And so you're actually doing the game of fusion is all about trying to protect this plasma from its surroundings, which is a challenge engineering wise, but it also makes the system inherently very, very safe. If there's ever, if there was like a rupture in the containment vessel with the plasma, then the machine just shuts itself off. And so because of that, we said, well, we need a different regulatory regime than fission, because that's very different than fission, where it's the other side, where you're trying to control this chain reaction and make sure that you don't have a chain reaction that runs away. And we said, okay, we need a different regulatory scheme than fission. And we actually, in the United States, we have that now. So the NRC, the Nuclear Regulatory Commission, passed guidance, which has actually been codified into law now, that regulates fusion similar to particle accelerators, which is really more the case that the fusion devices operate more like particle accelerators, where they do make instantaneous radiation, but it turns itself off. You shut the switch off and the device turns off immediately. And so I would say we have a much more favorable regulatory regime than, a couple of years ago, it was unknown how we would be regulated. And it would have been a really big mistake to regulate like fission, because it's just the inherent characteristics of the system are so different.
So, two more questions.
Yeah.
One is, so you have all these, growing investments, you have advancing technology, and yet you sort of, oftentimes fusion isn't included in some of the predictions for electricity generation, right, over the next, 25 years. What do you think is the case for getting it in there?
I think it's a lot sooner than people think it's going to be. I think the case is, you can look at the growth of the industry, going back to even just, I know it's kind of a very general metric, but if you just look at where the investment money is going, right? People are smart, people are seeing this space really take off, and the investment dollars are pouring in. And I think that's a really good indicator that, I don't think it's necessarily a causation, it's sort of reverse, right? But it's an indicator that, that people are really starting to take this seriously. And, the people that invest in this are taking a serious look, at least in our experience, people are taking a look under the hood and saying, okay, like send diligence teams in and see if this is for real, and then putting money into the space. And so we see that as a really good sign. And I think it's probably not going to be too long before you do see fusion in every single energy projection going forward. I do think, that probably this moment of demonstrating net energy in a commercially relevant way would be another catalyst for that. Although I don't think that at this point, I think there's enough people that have looked at the science behind it and said, yes, this is actually possible. And they've looked at the engineering challenge and say, yes, there's an engineering challenge, but we've done really, really hard things before. We sent people to the moon, like almost 50 years ago, right? And so like we're really good as a species at engineering challenges. And so I think people are really seeing that this space, there's a whole bunch of advancements that are happening, and especially going back to, one of the really exciting things, like I came out of the academic community, and we still as a company have a lot of ties to the academic community. But one of the really exciting things about seeing this go into the private space and in the startup space is you see these fast iteration times and these cycles, and you can just see the flywheel just continuing to turn, of people generating ideas, trying the ideas. Sometimes they work, sometimes they don't, but you keep that flywheel going and you can see the progress just picking up. And people are coming up with clever solutions for how to solve the engineering challenges behind the systems.
Great. That's a great place to stop, I think. Thank you so much. This is really interesting, and we really appreciate your time. So thank you.
Yeah, thank you very much. It is a very exciting time.
Thanks, Allison. Brandon has me convinced fusion is on its way. But it really has to get here. Unlimited power without fission's radioactivity and safety challenges? It will have been worth the wait. So I'm here now with Teresa from Nanoplume. Teresa, I know you've just started with IndieBio. What are you doing as a company, and what are you looking to progress to do?
So at Nanoplume, we're manufacturing super insulating materials, biomaterials. So I think that's an important part. The material itself has been around for a long time, has been used by NASA to insulate the Mars rover, for example. So it's really highly performant, but the process so far was not scalable. We are focusing on two types of innovation. One is on the material side. So we developed a new material formulation, much more durable, much cheaper. And on the other hand, we're developing a new process to develop this material.
So this will be a new form of insulation material that will be used for houses or for commercial cold shipping units or some things like that?
The long-term market is the built environment. where nowadays with all the regulatory changes coming up, the biomaterials are, I think, necessity in the future. But the material, it's like a platform product, so it can theoretically be used in many other use cases. For example, the cold chain could be another interesting use case.
Yeah.
So it's about really energy efficiency, increasing energy efficiency, but also protecting humanity long term from the rising temperatures. So I said a mitigation and also an adaptation component to it.
Yeah. Thanks so much for the work that you're doing. Appreciate it.
Thanks, Sean.
Now, on to the rest of the summit. The end of the Climate Tech Summit is within sight. We only have a couple of sessions to go, and to introduce the next one, let's welcome back Dr. Pei Wu, who you also met yesterday. Pei is a general partner at SOSV and the Chief Technology Officer in San Francisco. Over to you, Pei.
Hey, Sean. Happy to do double duty for the summit. Our next session is entitled Big Tech's Net Zero Energy Problem. In this session, we're really putting big tech's feet to the fire because of the huge power demands their data centers require. So, in 2023, Google and Microsoft alone consumed 24 terawatt hours of energy each. That's the equivalent to the consumption of 2.3 million American households. Now, big tech's energy demands are growing even faster thanks to AI's compute requirements. Where will the energy come from, and how can big tech keep it clean? Meaning, where are they going to find the clean energy to meet their published climate goals? For this session, we have one of our favorite moderators from summits past and present, Casey Crownhart, a senior climate reporter for MIT Technology Review. She covers topics from renewable energy and transportation to food and climate policy. She's the author of The Spark, a weekly climate technology newsletter. Over to you, Casey.
Thank you. I'm so excited to be here moderating today's panel. We're seeing increasing concern about energy demand and resulting emissions from big tech companies, partly driven by the boom in artificial intelligence. Today, data centers consume around 1 to 2% of all power. That share could double by the end of the decade, according to some projections. Big tech is really faced with these twin challenges: secure consistent energy to meet growing demand and quickly reduce carbon emissions to meet their climate goals. Today, we're going to talk about how companies might overcome these challenges and what it means for others working in climate tech. And to do that, we've got two great speakers who are right in the middle of these very thorny issues. First up, we have Carolyn Golan, Global Head of Energy Market Development and Innovation at Google. She leads a team there working to meet Google's energy needs while driving towards the company's emissions goals. Also joining us today is Rich Powell, CEO of the Clean Energy Buyers Association. The organization has 400 member companies, all looking to clean up the electricity system, including a goal to reach 90% carbon-free grid in the US by 2030. So excited to hear from both of you. Thank you both so much for being here today.
Thanks so much for having us.
Yeah, of course. Of course. So I want to jump into kind of all the solutions that both of you are looking at and considering. But Caroline, I want to start by asking you to kind of set things up for us a little bit. Google's emissions were 48% higher in 2023 than they were in just 2019, which you guys kind of use as a baseline for some of your goals. Can you talk about, this huge challenge that you face with increasing energy demand and how you're thinking about the task of cutting down emissions over the next, maybe decade or so?
Yep, sure. Happy to. And thanks for having me today. And I look forward to the conversation. It's always good to spend more time with Rich. However, we spent a lot of time together last week. So hopefully we can say something intelligent this week. I think that where Google is sitting right now is sort of at the tip of a massive transformation in our economy. And we're sort of the first wave, along with, our other counterparts in the ecosystem, around what is going to be just a huge transition in the way we think about the importance of the grid and the way we think about the importance of electricity and the type of electricity that is sort of powering the future. So right now, yes, data centers are at the forefront, and our load is growing and has been growing and will continue to grow. And it's growing because there's economic demand for load to grow and because the economy is shifting, and we're shifting into this digital economy. But sort of right behind us is the electrification of the traditional industrial economy. And then right behind that is electrification of transport, and then the electrification of residential and commercial demand. And you layer on top of that, you have new industrial manufacturing demand coming up to try to meet this digital transition, whether it be chip manufacturing, battery manufacturing, the like. So you just have this huge explosion of need on the system. And I think that, yeah, data centers are at the forefront, but data centers, including Google, Amazon, Microsoft, and all of us, we've also been the most transparent and the most, honest about our desire to decarbonize nations in this transition. So yes, we're sort of at the tip of the spear, but I think we're just the beginning of a huge wave of industrial growth and sector growth that is not only going to put more demands on the electricity grid, but it's going to matter how that electricity system services the needs. They're going to care about the generation profile. They're going to care about whether the electrons are clean or not. They're going to care about how reliable the system is. And so there's a lot more caring going on, which is a really interesting place to be in. And I think where Google is attacking this is saying, okay, we were the first company to put out a goal in 2020 to decarbonize our industrial operations, which is our data center fleet and our large office building campuses, right? We did that not really knowing that this huge wave was going to happen, but it put us at the beginning of the conversation how to do it. So now we're there and we're talking to everyone under the sun on how do you do this? And how do you not just do it for Google, but how do you do it where it's replicable so anyone can achieve this? I mean, whether, across the globe, we're seeing increasing policy pressure and increasing alignment on the need to decarbonize the grid, to hit a net zero economy, to hit emissions goals, and also just to produce that economic benefit across the board. So where Google is positioning itself, and it's really a humbling position to be put in, is how do we spur the innovation in the business models, the technologies, the regulatory structures, policies, partnerships, to sort of bring to bear all these new solutions that not only we're going to need to decarbonize our own footprint, but that whole wave coming behind us is also good.
Great. Thanks so much for getting us started. Rich, I want to hand it to you. You have kind of an interesting perspective, not coming just from one company, but working with a bunch of them. So can you talk about how you'd characterize this moment?
Sure. Well, first, Casey, let me just say a huge thank to you and to the SOSV team for convening all of us here for all of these conversations. It's just an incredibly exciting time. So, big step back, our membership at the Clean Energy Buyers Association, of which I'm very honored Google is a wonderful part, as a founding member, now comprises, as you said, more than 400 companies. Of those, more than 200 are buyers of electricity, and it's 200 of the very largest buyers of electricity in the world. All of them have shared commitments to buy that electricity clean, and they're supported by other members that produce electricity or provide services and technologies to help them do that. Collectively, our members are the largest demand signal for clean energy, certainly in North America, and one of the largest around the world. So to date, as of Q2 this year, they've contracted for 84 gigawatts of new clean electricity in North America alone. So that's almost all wind and solar in North America. That, just for context, for those of you that aren't energy nerds out there in the audience, that would be like all of the renewables in California plus all of the renewables in Texas put together. We're significantly more than that. So we're by far the largest thing in North America. It's a tremendous accomplishment, and we are only getting started. Some of our members are very advanced in that journey. Some of them have even met all of their annual demand for electricity with clean energy that they've purchased. Others are just at the beginning of the journey and are just getting started and learning how to do that. As our members have done this, we've found a couple things. First, we came together to create a massive demand signal. So to tell the market, to tell suppliers in the market, come to the market with more projects, come to the market with more innovation. Mission is now accomplished on a demand signal. So it's now demand for clean energy, frankly, massively outstrips the supply of clean energy now coming in. That has both challenges and opportunities, right? So the challenges to that now are that we're seeing longer timelines and higher prices for new clean energy coming in to meet all of this demand.
but we're also unlocking all kinds of innovation in business models and in technologies and in ways of procuring clean energy for companies like those that we work with. And so that has led to folks finding new innovative ways to work with utilities. So the vertically integrated companies that manage a lot of power in our grid, and we can talk more about that. It's also meant that people are now interested in more technology. So as I said, traditionally, this has been largely about the variable renewable technology, so wind and solar technologies. We've bought an enormous, just in the first half of this year, our members have contracted for 8 gigawatt of wind and solar. So a massive deployment of that. And many of our members are also thinking about new clean firm technologies to complement that wind and solar. So they're thinking about things like enhanced geothermal systems or advanced nuclear systems, really long duration energies, new ways of using hydro, even ways to continue to use emitting resources like fossil fuels or biomass, but to put carbon capture on it so that it doesn't have the emissions in the atmosphere. So now our members are really thinking about all of these things, and they're now looking to the supply market to see who can bring the most compelling solutions at the best cost and with the best performance in the parts of the country and increasingly in the parts of the world that need that.
Absolutely. I want to talk more about kind of how you're seeing companies meet their goals. But Caroline, first, I want to talk more about kind of how Google is setting goals. So like Rich mentioned, a lot of kind of the interest can be on these variable renewables like wind and solar, which are getting really cheap. And so one kind of way of decarbonizing is to buy a bunch of solar that just kind of like evens out based on your company's electricity demand. Google has kind of taken a different tact, right? To say, hey, we're going to do 24/7 carbon-free energy by 2030. So can you just talk more about that goal, why Google set that goal, and like why it's maybe different from what others in the industry are doing?
Yeah, happy to. So around 2018, I think, which we had already at that point met, and we were the first company to meet the goal of powering our operations on 100% renewable energy, which meant, like many companies today, we went out, we added up all of our megawatt hours across our entire fleet. And then we went out and we procured in markets where you could procure wind and solar, the commensurate number of megawatt hours. That meant we were deploying a lot of wind in MISO, and we were doing a lot of, offshore wind in, Europe, and we were doing some solar here and there. But it was all sort of disconnected from our actual load, right? It was completely disconnected. It was just where could you deploy wind and solar? The real benefit of that approach was that we drove down the cost of wind and solar. I mean, we standardized the first renewable PPA for the rest of the market, then worked with SEBA to figure out how to teach others how to do this. So a lot of benefits from that approach. We got the kinks out. What we realized around 2018, after we had met 100% our goal, was that we took a step back at our portfolio and we realized that as our load was growing, we were still very much running on fossil fuel. And utilities were actually keeping coal plants or gas plants online to meet our load, even though we were deploying all this capital into the market, for renewable energy. So we said, well, if we're really serious about this, what do we actually need to do? And we came up with the concept of 24/7 free energy. And what that really means is that we are committed to powering all of our data centers and our large campuses with carbon-free energy that is local, hourly, and technology inclusive. So what that means is for every place that we have a data center, we have to source power, clean power, in the same balancing authority that data center sits on. So that could be an RTO, that could be a vertically integrated utility. It has to be in the same balancing authority. So we have to develop those projects locally. It also needs to be time-based, which means we are looking at our hourly demand signal, and we are matching that with an hourly profile from the resources output profile, so that every hour that we're investing in is matching what our hourly needs, so that we're not overbuilding in hours 2 p.m. to 6 p.m. And we're smoothing it out across the entire load profile. what that does is it forces us, and this is where the last part is really important, it forces us to look at those other hours that solar and wind aren't necessarily hitting. And so that's why it's also technology inclusive, because we recognize to fully decarbonize the grid and to do it reliably and to do it cost effectively, you're going to have to spur these other technologies. And so we took a really technology inclusive goal, which means we are looking at storage. We are looking at geothermal. We're investing in geothermal. We're looking at advanced nuclear. And then we're looking now, I would say, at a multitude of different options. I think in the last couple of years where we've seen the capacity crunch, we've even been involved in our thinking again, which is to say, okay, 24/7 is actually the way in which we force ourselves, and it's sort of this inherent belief that we need to fix the markets, right? If you're forced to buy locally and hourly, you're going to come to terms real quickly that there isn't a market structure out there or a business model out there to fully decarbonize any industrial. There's no grid out there that's set up for this. So it forces us to really get engaged where we are. That forces partnership. That forces us to lean in and think more innovatively. I think it also forces us to come to terms with the things that are broken in the system, right? And address them head on. And I think in the past 2 years, where we've really come to terms with the fact is that as growing economic development on the system, growing load on the system, we needed to come up with a capacity. And so I think that we've now transitioned into this era of 24/7, where we're very, very interested and very committed to these advanced technologies, not only because we need them to meet our 24/7 goal, but because the country needs it to create clean, firm solutions for what is, a large capacity growth need across the country. And so we've sort of shifted into this place, which has been really, really exciting. I think the trade-offs generally, with 24/7, it's really sticky. It's really hard. You have to roll up your sleeves. You have to work in sort of the nitty-gritty. But I think what is inherent about this goal, and what I think will be sort of the legacy of it, is that it's going to spur models and frameworks and opportunities that can be replicated by really any customer. And I think that's going to help to drive the overall grid decarbonization agenda, which we all know we need, and we need faster if we're ever going to meet sort of our net zero goals and also sort of stave off the worst of climate change.
Yeah, it's really interesting. I think seeing increasingly larger companies like Google, like some of your other members, kind of go out and get the power that they want. I think in one version of this, we can see, companies kind of sit back, twiddle their thumbs, and just wait and say, we would love clean energy. Somebody bring it to us. And I think that we're seeing some evidence that, that's not going to be enough for companies. I'm thinking specifically of a recent deal that we saw, within a few weeks, the Microsoft and Constellation Energy deal to, that basically is going to reopen a closed nuclear plant. Rich, I'm curious, just from your perspective, how you're seeing companies interact in these ways, maybe whether it's bringing old nuclear back to the grid, hopefully, getting some new carbon-free energy built. Those interactions you're seeing.
Well, Casey, I think you're totally right that this moment is, I think, helpfully forcing companies to become more proactive about this. It's no longer the case that they can just wait for, hundreds of developers to come to them with projects for building new clean energy. And so they're bringing their own ideas. I think that was certainly true with Google minting the Fervo deal with Nevada Energy to bring enhanced geothermal into the system. And obviously Microsoft with the Constellation deal to restart the 3 Mile Island nuclear plant, soon to be renamed the Crane Generating Station to the late great.
Big rebrand there, yeah.
It's probably a good move, but it is quite a there's poetry there, right? Something around the Phoenix Rising or something. But that is an extraordinary deal. I mean, for the folks that are not energy nerds in the audience here, it's in the end, to Carolyn's earlier point about capacity, the capacity factor of a nuclear reactor is on average about 4 times higher than solar. So you could think of this deal as having, it's an 800 north of 800 megawatt deal, but if you were comparing that to solar, for example, it would be like 3.2 gigawatts or 3,200 megawatts of solar in terms of, effectively the total output of the thing. And just the grid that is being re-added to, which is the PJM regional transmission organization in the United States, is a very capacity strapped grid. They just had a capacity auction in that region where the prices were sky high because there's simply not enough long-term firm power in that region in order to reliably supply that region. And that region was potentially headed for some real reliability challenges. So this new capacity coming back into that is going to be enormously helpful for that grid. And it's a huge amount of clean power added to that system. Some of our other members, General Motors, for example, is attacking this in other really interesting ways. All of their car models starting in 2026 are going to have bi-directional charging for the electric vehicle. These are big electric vehicles with great big batteries. So, think things like, Escalades and Hummers and things like that. And just a couple of these things connected together with bi-directional charging actually can hugely add to a grid's stability in many regions of the country. These things are going to be out there and circulating around. And then other groups of companies, so Google, Microsoft, and Nucor, three of our members, are working together on a request proposals for a variety of clean firm technologies to try to surface more information. Maybe Caroline can say more about this, about all of the technologies that are out there that could come forward on this. And so we really have a lot of activity from members pulling forward new, often clean firm technologies into the mix.
Yeah, Caroline, I think whether it's, talking about the Nucor deal or maybe the Fervo kind of partnership that you guys have built, talk more about just how you're interacting with maybe kind of startup companies or companies trying to bring these new technologies into bigger prominence.
Yeah, I'm happy to. It's the most fun thing, we get to do, actually. So the Fervo deal, I'll back up and say, similarly, 2 years ago, we saw the need to create a business model that would allow us to invest in these advanced technologies and get the real value for them from the system, which is this capacity delivery, right? That is the real value back to the system. Historically, us and just about everyone was really just playing an energy-only game. Everyone was signing PPAs for energy plus RECs. But I've said this before, I can't build a data center on RECs, right?
And those are, sorry, just to cut in for, again, the maybe policy people, renewable energy credit is
renewable energy
credit. You're basically paying for renewable energy somewhere else.
Renewable energy credits, right. And so we saw this. We also were looking at IRPs across the country, and we could tell we're going to need a capacity solution really quick unless we want to be powered on natural gas, and we didn't. And so we came up with the clean transition tariff. And the clean transition tariff, if you think about it, it's really just a way for a customer and a utility to come together, go out to market, and procure clean, firm technology stack that is above what is regulatorily allowed for that utility to invest in, allow Google to be that anchor customer that pays that marginal difference, and then allows Google to receive the full benefit of that technology, which is capacity, back onto their existing energy service agreement. So it keeps them a customer with the utility, and it allows the utility to go out and source technologies that otherwise they wouldn't be able to. And there's multiple benefits, but one of the benefits of this is that it allows Google to catalyze and sort of accelerate the integration of this novel tech in a way that we just know wouldn't happen were we not willing to be that investor. And in most of the country where there isn't a liberalized market, we're not really able to go and be that investor and see that full value back on our energy service agreement with the utility. Because for most industrial customers all over the country, you still have a utility bill. Whether you have a whole portfolio of investments in renewable energy, you also have a utility bill. So you have sort of these two balance sheets. And we really wanted to integrate the two, and we really wanted to get the utility out there being our partner in sourcing these new technologies. So that was the motivation. We've landed the first one with NV Energy, who is a wonderful partner in this. And we are having multiple conversations along with some of our other SEBA peers across the country and replicating it. But the NV Energy deal was with Fervo. And so we went out and NV Energy actually signs a PPA with Fervo for advanced geothermal, about 115 megawatts. And then it's a financial sleeve back onto our bill, and we get full capacity value for the generation of that geothermal. It allowed NV Energy to get comfortable with Fervo. It allowed Fervo to get comfortable with NV Energy. We served as sort of that broker to create this new tariff, which we think is going to be replicable across the country. We're already seeing a lot of interest from regulators, utilities, because it keeps the investments together. It keeps utility investment, customer investment together, and that's what's really wonderful about it. But it also what it allows NV Energy to do is say, okay, this is going to scale geothermal and commercialize it in a way where it's probably going to be more cost effective within the next 5 to 10 years, which means it's going to be more accessible for the rest of NV Energy customers. That's the real interesting part of this, is that we're utilizing Google's willingness to pay, their leadership to create catalytic change for customers across the system. And I think that if we can think through this together and really scale this across the country, I think it's going to get utilities, when you have a capacity need out there, a lot more comfortable with going after the more innovative solutions and the more near-term solutions. So we're hoping to use this to catalyze grid-enhancing technologies, to catalyze virtual power plants, to catalyze all types of storage and SMRs alike. It's really about aligning the capital structures so that our dollars plus the utility dollars plus LPO dollars and all the other, grants and equity out there can really be utilized towards the same investment as opposed to different balance sheets.
Really interesting. So it's always fascinating to me when it's not just about the technology, but about, getting it onto the grid and figuring out who's paying for it and how and everything else.
Business model. Yeah.
I could talk about this for hours with the two of you. Unfortunately, we are already approaching the end of our time. Just really briefly, I'm curious for kind of closing thoughts for both of you and how you think about maybe just from now until the end of the decade for this industry and getting, clean energy and into everybody's hands.
I'm happy to start. So, if you're a clean energy nerd like me, so if you're somebody who's kind of obsessed with getting grids in the U.S. or maybe even the whole world to net zero, that was always going to require tremendously more electricity. Like that was always going to require doubling, maybe tripling the size of our grid. So it was always just a question of how quickly we were going to start accelerating, our grids up as we electrified vehicles and industry in our homes and everything else. That was always the plan. This moment is accelerating that plan, perhaps by a couple of years, because we have this incredible new economic opportunity in the United States with high tech and semiconductors and manufacturing and all of the things that are driving the even faster growth in load. And that is an incredible opportunity. It's an incredible economic opportunity. It's also just an incredible opportunity to demonstrate all these new business models and all these new technologies, and frankly, to reset and even increase the level of ambition that companies like those in our community are representing as they push forward. So I would hope people take away from this and maybe this entire series of conversations that it's a really exciting time, and boy, that we need a lot of time and brilliant people and innovations weighing into this, because we're going to need a lot of solutions for all of this to work. So I would just thank everybody for weighing in on this, and hope everybody will bring their best ideas.
I second everything that Rich says. One thing maybe to leave the audience with is that this is a real period of alignment. Like, we really need alignment across all the players, because we have a window. We have a real interesting window, I say, over the next 5 years to accelerate the technologies, as Rich said, that we always wanted, that we always needed on the system, to accelerate the policies, to accelerate the regulatory structures, to accelerate the business models. It's very rare to see sort of this confluence of demand, ambition, and capital all at the same time, right? But if we don't align on how we're going to meet this challenge, my fear is that we will end up knee-jerking into what we've always done, right? And so for anyone in your audience, really, really learn the utility business. Really, really understand how utilities think about meeting capacity needs, about meeting reliability. Because the name of the game is now first to clean capacity delivery. If you have a technology or a solution or a framework or a program or a business model that you think could accelerate clean capacity delivery on the system, then you've got something worth talking about. Figure out how that fits in with the utility's responsibility to serve this industrial growth. Because at the end of the day, those are really going to be the players that have to stand up and say, you know, we are comfortable taking on this challenge because we have the tools in the toolkit. And I think for a long time, that business model literacy hasn't really been out there. And so I'd really just encourage the audience, learn that business model, be able to think like a utility, and then start to think like a customer, right? And if you can marry those two things together and you have an idea on how to bring clean capacity quicker on the system, get involved.
Great. Thank you so much, both of you, for joining me today. And thanks so much to the audience for tuning in.
Thanks, Casey.
Thank you.
Thank you, Casey, Carolyn, and Rich. It's really interesting to see this conjunction of tech, energy demand, and clean energy generation. A year ago, I would never have imagined the tech's drive for bigger data centers would bring about such a surge of interesting clean energy initiatives, especially nuclear fission. For our next session, I am happy to bring on Sierra Brooks, who is a senior scientist and analyst at SOSV's San Francisco office. She is responsible for sourcing and doing scientific diligence, as well as for supporting the SOSV portfolio companies working in our San Francisco office. Sierra completed her BS in chemical biological engineering at MIT, and she received her PhD in chemical engineering from the University of Texas at Austin. Over to you, Sierra.
Thanks, Sean. It's great to be here. And welcome everyone to our Chem Lab at IndieBio San Francisco, where you can see plenty of analytical chemistry equipment behind me that our startups use every day. The title of our next session is Steel and Cement's Electrifying Futures. Steel and cement production make up 15% of global greenhouse gas emissions. And in the past 4.5 years, investors have funded dozens of startups aiming to decarbonize these indispensable industrial sectors. Compared to energy generation, where winning renewable and clean technologies are well established, the best approaches to decarbonizing steel and cement are far from settled. Both MIT spin-out Sublime Systems and Electra use novel electricity-based technologies to create green cement and steel, and both are on the path to their first production plants. Sublime with an $87 million federal grant, and recently another $75 million from Holcim and CRH, and Electra with an $85 million seed round backed by Bill Gates' Breakthrough Energy Ventures. The greening of steel and cement may hinge on their success. Our moderator for this discussion is Dr. Julia Atwood, who's an industrial decarbonization specialist at Bloomberg NEF, and she also has a PhD in materials engineering from the University of Cambridge. Over to you, Julia.
Thanks very much, SOSV. And thank you all for joining us. We're really happy to be here. I'm very pleased to be joined by Leah Ellis from Sublime Systems and Sandeep Najalan from Electra. We're going to be talking about electrifying heavy industry today, and these two startups are some of the leaders in doing that. So I'd like to have you both start with just giving us a sense, the 30-second explainer of how your technology works. So Sandeep, I'll start with you.
Thanks, Julia. Just excited to be here. So Electra's mission is to develop clean, pure iron resourcefully and responsibly to help build the future from ground. And why clean iron? That is because, steel is 98% iron, and 90% of its emissions come from making of iron first in order to make steel. What we have developed is a process that's an electrified platform, as you mentioned, and it takes electrons, actually green electrons that are renewable in nature, and converts the variety of ores we can find already mined in the mines to commercially available ores, and then we convert that into pure metallic iron while minimizing the waste across the entire value chain. In simple terms, if I was to put it in, we take ores, we put them into solution instead of melting them like in a blast furnace. And that solution is purified, and we remove impurities that are coming through the ores as co-products, and that zap solution within electrons and extract iron out as a pure metal.
That's fascinating. Very different from how we make iron and steel today, but extremely important if we're going to decarbonize. And Leah, Sublime is focused on cement. Can you run us through how your process works?
Yeah, if may help to start by talking about how cement is made today. So cement is currently 8% of global CO2 emissions. We use more concrete than almost any other material in the world. So it's made in these big rotary kilns. So taking limestone, which is a calcium carbonate, it's about 50% by weight CO2, cooking it to extraordinarily hot temperatures, about the temperature of hot lava, 1400 degrees Celsius, which is very fossil intensive. So all in all, 1 ton of today's Portland cement results in 1 ton of CO2 emissions, half from the fossil fuel, half from the breakdown of these carbonate minerals. Now, Sublime is rethinking the cement making process in a way that keeps the final stoichiometric composition of hardened concrete the same, so same strength, same durability, but we're rethinking how it's made and from what materials it's made. So we take calcium silicate minerals, almost any calcium-bearing mineral, running it through a process which works at ambient temperature using electrochemistry to break down rocks instead of using heat to break them down. So the product that we make is a 1-to-1 replacement for Portland cement in terms of all the properties. Its stoichiometry is the same, which is the ratio of the minerals which react together once you add water, but the crystal structure is different because it's never been inside a kiln and heated to these temperatures. So that's how our process works and how it avoids the CO2 emissions. So I like to differentiate our technology from post-combustion carbon capture and some others by describing it as true zero instead of net zero, because there's no addition and subtraction, there's no carbon capture, which means that ultimately, once we get to the same scale as, these 1 million ton per year Portland cement kilns, we'll be able to have similar cost because there's no added cost, no added complexity of dealing with, that 1 ton of CO2 emissions for every ton of cement making.
Amazing. From hot lava to ambient temperatures, that certainly seems better for the planet. Now, steel and cement are enormous industries, and there are huge companies who are also trying to decarbonize. Steel in particular has been doing a lot of work. There's about 100 million tons of green steel capacity that's been announced. How do you both differentiate your technologies from the hydrogen or the carbon capture that they'll be using? Leah, you gave us the first part of that, true zero, not net zero. Sandy, maybe you can talk a little bit about how you will differentiate your material from that made by the big incumbents.
Yeah, I mean, if you think about differentiator at the end of the day in a commodity material, you first have to start with cost. And we believe we have the lowest cost to achieve steel making by producing the iron through our process. And this can be broken down into two parts. One is that if you look at the total cost of producing, let's say, iron to get to steel, 70% of that comes from two factors. What is the cost of energy to make this happen? And what is the cost of iron ore that you need to convert into iron? And on both the fronts, we have a very strong economic lever that we are bending towards in our favor. On the case of energy cost, being also a low temperature process, like what Leah described, that we're not doing molten metal at 1600 degrees C. Our plant is operating at sub 100 degrees Celsius, and nominally around 600 degrees Celsius on certain parts of the plant. We are able to follow the availability of electron and thus seek intermittent power versus base green load. And that reduces the cost of the electron by almost 3x. And on the ore side, we have very high degree of flexibility, not to use the commercial ores, but also be able to use ores that are currently not being used. So they are really low value in the ecosystem or in the value chain. And hence that reduces the cost of that lever as well. The second one is value we produce. At the end of the day, all irons are not created equal. We have a 99.9% electrolytic grade iron, and DRI, which is another competitive way to get there. Best case scenario, if you want to do economically, is about 88% metallic content. Pig iron is about 94% metallic content. So having more iron and less impurities creates value for the steelmaker. We also create value by refining all the impurities into co-products that increase gain value for the overall ecosystem, like alumina, which is a tramp impurity that blast furnaces or DR grade pellets cannot use, and we can extract them and we can refine that as pure alumina and feed into aluminum making as a byproduct. And last but not least, it is actually in the area of steel making, we are the most modular approach to get there. That helps with scaling. That helps with making the economical viable unit that can be demonstrated much smaller, and massively increase the learning rate that you need to reduce cost.
Fascinating. So cost, purity, and modularity being the places where you really see
value.
And
value as well.
Leah, is that similar for you? Is that how you're thinking about competing with the big cement producers?
Yeah, well, I would say we don't intend to compete with cement producers. Cement producers today are, it's all about logistics and operations of trying to get massive amounts of material to the concrete companies. So it's all about moving, with barges and rail and terminals and harbors and trucks. So we see them as our execution partners, and they're just as committed to carbon reduction as we are. And we see ourselves as the technology provider and the technology partner, where the two of us work together to have this swift and massive impact in CO2 emissions. So the way I like to think of really the climate problem broadly is like, I use like the leaky tap analogy of, imagine a spigot that's broken and there's just, CO2 spilling out everywhere. It's sort of like a crisis situation where you need an all of the above approach. And the first thing you do when you have a leaky tap is put a bucket under and collect it right at point source. And so I see that as being the post-combustion carbon capture. It's a necessary temporary solution that you do in order to fix the tap and to get to that true zero permanent fix, which may take longer, which may require expertise and new parts to be ordered and for those things to happen. And so there are things that the industry is doing and can do, both to capture CO2 and then also to make sure there's less effluent coming out of that pipe. So the industry is moving very quickly with supplementary cementitious materials. So there are cementitious materials that can be blended with Portland cement that have lower carbon reduction, but you'd have to start sacrificing performance at a certain point once you blend too deeply. And so those things are happening right now, and that's great. We really need everything. And so what I see Sublime coming and doing is being that solution for the ultimate way that we will make cement in the coming millennia for a post-carbon world. So we do think it's an all of the above approach. And of course, it all comes down to cost, and that's actually very difficult for cement because, some people ask, like, your cement, like, sure, it's green and maybe it costs the same, but like, how is it better? How can you make better cement? And truthfully, there is no such thing as better cement. People won't pay a penny more for better cement. They just want the same cement, right? But there is one thing that people care about in cement, especially on the concrete side, which is the reliability. And that's reliability in terms of logistics. So having the materials show up in time and the quantities and the quality that you want. And that is a place where Sublime can have an advantage, because today you make cement by taking a carbonate rock, which contains impurities, baking it, in which case it loses half its weight to CO2. All of those impurities get concentrated, and it picks up impurities from the bituminous coal that you're burning to get to that high temperature, and from the tires and plastics that you're burning in these kilns to reduce the amount of fuel you're using. So the quality of cement actually varies quite widely. And because the construction industry is rightfully conservative, you take the standard deviation of how much that cement quality is varying, and you add a multiple of that in terms of over design to make sure that you're appropriately covering your butt. And this is something everyone does. It's mandated. So by making cement that is pure, because we create, I don't know if you've seen pictures of sublime cement in the field, it's much lighter in color because our process is inherently purifying. We're taking a mixed mineral, separating it into its constituent minerals, and blending it into a cement. So it's inherently purifying. The quality of the output doesn't necessarily depend on the quality of the input. So we're hoping we can prove, once we're at scale, that our cement is more reliable, that you can use less of it because it's more consistent, and that its performance, day to day, week to week, plant by plant, is the same. And so I think that's what better cement means. It's not really in terms of properties. The properties are necessary but not sufficient. It's about making sure your customer can rest easy and get along with business as usual with the least amount of cost.
Absolutely. That has actually brought us on to the customer side of things, which is something that I wanted to touch on. You made the point that a customer, wants the thing that they have always bought before, but I think they are now becoming a little bit more discerning and also wanting it green. Sandeep, have you found that this can be a barrier when you're talking to the people you want to buy your steel? Are they saying, well, how do I know it will operate in the same way? How do I certify it? How have you been demonstrating that it will work just as well?
A number of ways. First of all, I think one of the key distinctions versus, let's say, cement would be is that, we produce RN. And this RN is a product that is used today to make steel. So we are substituting, we are a substitute to RN. And then what's also unique in the steel industry is when it's supposed to go in an electric arc furnace, is that we melt this RN along with scrap to make the new steel. So in fact, the RN that is coming with anything that we are bringing in is already washed out, is already reset, and we reset the entire crystal structure to give the reliability the steel actually needs to produce. So the risk of us from a certification perspective is actually, first of all, low, because we are substituting that is already existing, and then we are going through a process in which the memory of where this RN came from has already been sort of washed out. Having said that, we do see that there are a lot of new segments that the blast furnaces needs to be taken out of, and electric arc furnaces needs to come in. Example would be like a car body. The top surface of a car body is a part that's typically made in a blast furnace today, because that's more pure way to make steel. And EAFs have to sort of get there by seeking more pure iron from us, hopefully, to produce that. So that product qualification cycle obviously has to be redone for, let's say, automotive company. And as a result, the path we are on is to build a demonstration plant that we can produce that amounts of iron that is needed, that we can give to the steelmaker, that can make that coil, that can be stamped out to the part, so that the end demand user, let's say in this case could be an automotive car company, can qualify also that part and qualify along with us that yes, that the purity of the iron actually help them get to that part.
Amazing. So the iron going into the steel making process, you will see at the end that the part is exactly as it was intended. Leah, when you were talking about the over-designing that often happens in the building sector, how you have to add more and more cement and concrete to make sure that you're at the performance standards you need, do you think that is an important part of the value that you're bringing, the fact that your cement is very pure and you can use less? And do you think that value will actually be realized when there are these standards that people have been doing for so long? Do you think that's a big hurdle to overcome?
Yeah, I think there's immense value in making sure that your cement is very consistent. There's this whole admixture business to tune the properties of the cement. So I do think that's very big, and that there is this question of risk and making sure that you don't, it's funny, like in Silicon Valley, people say like the tagline is move fast, break things. And that's not something that you can do in construction. So our product roadmap, we call it Sidewalk to Skyscrapers. And we're working with Don Davies, who is longtime president of Magnuson Clemensic, a big structural engineering firm, to get a protocol for how you test things in incrementally challenging applications so that you can work with the industry and never push them beyond their comfort limit, and that you're listening every step of the way and getting their feedback and using them as part of your team to develop your product. Because truthfully, the cement industry is so massive that even if you can only do basements, sidewalks, mud mats, like footings, that is still a massive total addressable market. We can use all our cement in that. It is our goal and our ambition. We have a very clear path to being that full drop-in replacement for Portland cement everywhere that Portland cement is used, but there's no point in rushing it. And so, you don't want to ram things down people's throats, especially as a startup coming into a very big industry where, you really have to respect how things have been done, how people want things to be, and you have to make that a reality to them and really listen. And so that's what we're doing, and it's honestly really, really fun.
That's great to hear. And the process that you outlined, where you start with a sidewalk and you end up in a skyscraper, that brings me to the question of scale. So I'd love to know the scale that you're both at right now. How much material can you produce, and how does that compare to a typical plant in your industries? So Sandeep, can you tell us where you're at right now?
Yeah, so we are at a pilot scale. So we're already in existence. So we have a pilot plant that is producing iron. The nominal capacity of the plant is 100 ton. And next year, our goal is to build a larger demonstration plant to scaling this technology, as well as producing iron that as I said before, would be used for qualification purposes. And that obviously is much larger scale, largely because, and a steel mill is so large that an EAF melt is a 200-ton melt, which is, think about putting 200 cars together and melting in 1 hour. I mean, that's how the magnitude of that melt process is, just to give you an idea. And we could be putting in easily 30, 40 tons of iron coming from Electra into that. We need to obviously expand capacity for qualification purposes. At the end of the day, a large-scale steel plant is about 2.5 million tons in capacity. So then we have a roadmap to get to a first commercial plant, and this is where modularity, which I mentioned earlier, is so critical, that you can step into the size and as well as prove the scale up, as well as cost, as well as economics, product qualification, all of that in a stepwise manner to get there as quickly as possible.
And Leah, you have a partnership with Holcim. Is that something that's going to help you accelerate your scaling plans?
Yeah, we have partnerships with both Holcim and CRH, so two of the largest cement producers in Europe and in North America. And they're absolutely helping us. Going back to that part of, we know what we do well, which is technology. We know what they do well, which is logistics and operations, things that are not to be underestimated. And frankly, don't make my team get out of bed. Like, we're nerds, right? So we bring the tech, you bring the muscle of getting this to market, of distributing it to hundreds of ready mix plants and making that into quality concrete. It's these types of partnerships that allow swift and massive, instead of like going it alone, which, we would never go anywhere if we were going it alone. It's just far too capital intensive. And frankly, all this land and resources is locked up. Like, good luck as a startup raising VC money to like buy a barge, right? Or a terminal in the Boston Harbor. So that's going to be really important to us. So going back to your other question about scale, we've moved from lab scale to 250 tons per year in the past 4 years, even during COVID. So the first step was going from grams to kilograms continuously, and then from that R&D continuous to pilot plant continuous. And we did 2 scale-ups. First, 100 tons a year, and then we wanted experience scaling it again to 250 tons a year. And each time you're matching the quality of the material that you're producing in R&D, because how you operate the process really affects the quality of the cement. And so now we're gearing up to do our next big leap to 20 to 30,000 tons per year capacity. So this plant is called our industrial demonstration plant. It is a module, and you're saying this as well. The modularity is so important, because to get to massive scale, you can do it 2 ways. You can do it by making it bigger, and there are cost efficiencies by simply making things bigger, like pinch and zoom bigger. But there's also cost efficiencies, especially, and speed efficiencies from making copy-paste units. And the cost down you get from doing that may actually be similar to the cost down effect from simply making it larger. So defining your module, running that at very large scale, getting all of the economic quality data, that allows you to get closer to being project financeable, because you've reduced risk. You have no more technical risk, no more scale-up risk. It's all very well understood, and you simply replicate. So that is the point we hope to get to with this demonstration scale plant. Recently was announced an $87 million grant from the US DOE to do a significant cost share of that project. So that is currently what we're focused on, is taking all of this process scale-up knowledge and moving it to an orders of magnitude scale larger. And then also working with Wholesome and CRH to find sites where we can build these 1 million ton per year plants, at which point we can get the volume up to drive down the cost. And as you know, like siting, permitting, all these things take many years. And so we're starting now to make sure that once Holyoke, this demonstration plant, is complete, we can hit play and start engineering these bigger scale plants, all in the spirit of swift and massive.
That's incredible. I think you are both beating the stereotype of hard tech taking an extremely long time to develop. You've both moved very quickly through these phases. I have one final question about scaling, and then I want to move on to talk about financing in the last 5 minutes that we have. But my question, and maybe I'll give it to you, Sandeep, is these industries are huge. They have large assets. How do you see the transition between processes? Do you think you have to wait until all of these plants naturally retire? Do you think there will be disruption? What does that look like?
Yeah, so I think it's a very good question, because we have to be cognizant that this is a $1.5 billion industry with massive asset base. And somewhat similar to, how coal-fired plant power generation was and had been thought through as well. So the way I'm thinking through that piece is that, look, if you look at the blast furnaces that are in China, that is the youngest fleet of blast furnaces that are in the world today, like 14 years. So that's going to take obviously longest time to transition. But the rest part of the world, especially in Europe, North America, other parts of the developed world, or where the world capacity or the capacity has not yet been put, they are massively moving towards where we need to go, which is to recycle more steel, hence EAF steel making. And that's where we see, even at the scale of moving the shift that is going to happen and leaving even China aside for a moment, there is hundreds and hundreds of millions of tons of iron that needs to be fed into these electric arc furnaces, largely because the scrap that we have available, the reservoir for scrap that we have available, especially the high-grade, top-grade scrap that produces the highest quality steel, that resource is limited and it's not going to increase because that proportionally increases by GDP, how many cars you make, so how many parts you stamp, and whatever is left out of the stamp part is the highest quality scrap you get. So that reservoir is not increasing. So we're seeing this shift happen in the industry at the macro level that, yes, while depending on the age of your blast furnace, you will make an economic choice how to transition into a solution set that gets you to full zero emissions, like what we have here as well. But the size of the market presents such a huge opportunity that it's not a constraint from where we sit today, from a demand perspective, and is a massively supply side constraint that we are seeing.
Great. So filling a gap that scrap can't fill on its own. Amazing. Yeah. I want to talk a little bit about financing first-of-a-kind projects. This is a huge challenge. It's getting talked about a lot more in the climate conversation. Leah, you mentioned that you've had an investment from the DOE. Do you think there has to be some kind of government money involved in these first-of-a-kind industrial projects?
Well, has to. I mean, like, we'll find a way to do this by hook or by crook. But I guess the question is, what role does government have to play in clean tech, and should it play? And I think we all know that the cost of doing nothing is, much more expensive than the cost of participating. So there is a social cost to this, and we see this with the hurricanes in Florida, with the potential collapse of the Atlantic current, which I've been doom scrolling about a lot recently, and how that could affect temperatures in Europe and how that could leave a lot of hot water at the equator, intensifying these storms, etc. So we have to preserve business as usual. And there may be a cost to that, but it is far less expensive to preserve business as usual now than to adapt to a very uncertain environment where insurance premiums may go up, where things might no longer be insurable at all, where the cost of doing business goes up, So, I think that government does, capitalism and, public companies, they make very good short-term decisions. Like the invisible hand of capitalism will optimize and regulate itself in the short term to, make the best quarter-by-quarter decisions. It is government's role to provide like longer-term, constraints so that we can keep doing business as usual for as long as possible, because having a safe and prosperous society that is just very normal and safe benefits us all. And so there's a moment of opportunity now that you can invest to get these technologies demoed so that they can move to first full scale, so that the premium can be low, so that companies can start buying low carbon cement to qualify that, to lock up the supply and keep, future proof their supply chain. And so that hopefully we won't have to, put all of our money into adaptation and resilience. So there's a moment here where the ounce of prevention or, the megatons of avoidance are worth the gigatons of cure in the future. So I do think government has a role and a responsibility, especially in the domain of cement, where the U.S. government buys 50% of the cement that is used in the U.S. through Federal Highway Administration, DOT. Like, government provides infrastructure. So their demand signal here and their willingness to be part of the solution is going to be really important, particularly for the cement sector.
Absolutely. Definitely a vested interest there. Sandeep, I'm going to give you the last word in the last minute that we have. Do you think there's enough access to capital, and where is it going to come from?
I think so. I think there is absolutely, while it is challenging, as you think about being a startup that's not bankable, how are you going to raise the capital? But raising the capital, there is a method to this madness. And if I was to break that problem down, it comes through, look, you have to right-size the plant, even though we have volume and demand signals that is coming. What is a minimum viable plan that you need to go build to show economic viability to get industry relevant size that you can then grow from there? So you have to start from there as well. It's not like if you were to build, they will come. The answer is yes, they will come. But you also have to bring the investors with the capital to help you build that. The second part of that equation is that, if you were to look at inputs and outputs and you were to minimize the risk that is to the investor, and matching the tenor of inputs and output and guaranteeing an operating margin that no matter what way the market goes, you have minimum economic viability of the project, people are willing to put the money on that. But you have to, it's our responsibility to show and do this in a project where they are not taking the risk itself. And there are ways to do that. Pricing mechanism, what's your tenor of your financing that is matched to inputs and offtakes agreement, and pricing hedges that you can have both on inputs and outputs that guarantee almost that you are economically viable. And last but not the least, you do have to build a capital stack, and how are you financing it? If your project has an IRR of 10%, the answer is that there is only one pocket of capital that gets you there. Either is that the government or is the sovereigns that clear their hurdle rate, obviously, or is perhaps a strategic that desperately wants that product and say, I will deploy my capital to get there. And there are first movers that are willing to do that. You can improve your IRR by getting non-dilutive funding. For me, that's the role of the government that can play in it. That could be cash grants, could be credits, whatever those things that are available. But the bottom line is what I'm saying is if you build the right strategy here, which is starting from day number one, that you have to pass this chasm of scaling and you are not bankable and you put all the pieces into place, I believe with strong value proposition, there is enough capital on the table that is going to come and help you move this thing through.
That's great. That's a really positive note to end on. Thank you both so much for being here with me. I am feeling a little bit more helpful. Hopefully a vacation from doom scrolling for me tonight, if not you, Leah. Thanks so much, both.
Thank you.
Thanks so much.
Thanks, Julia. That was a great conversation. A few years ago, the idea of electrifying steel and cement looked very far off. It's still going to be a while before these vast industrial sectors green in a meaningful way, but it's great to see the tech proving out and the capital pouring in.
We're here in IndieBio San Francisco. I've got with me CEO and co-founder of Microma. Ricky, what have we got going on here in our lab?
At Microma, we make food dyes using mushrooms. And this is the first industrial scale production we did. We are producing big chunks of colorants, as you can see. And this colorant is a super potent colorant to replace red 40, red number 3 in food applications, which are harmful for our health, and consumers are looking for more natural solutions. Here it's super dark, potent color. As you can see, applying water, it's
a tiny bit.
Has a super strong concentration.
That's beautiful. Ricky, help the audience understand beyond the fact that red food dye, number 40 and number 2, those sound kind of problematic on its own, but help us understand a little more about why we need natural biocolorants in our economy.
These dyes are not only safe for consumption, but also very good in terms of performance, much higher than the current natural dyes that we have in the market. So more pH, thermal stable, and can be used in virtually all applications. So what we are bringing to the market is novel natural dyes that have better performance, that are produced in a more sustainable way, and still super good for our health.
I look forward to eating your products, Ricky.
Definitely.
Up next is Joe Hurd, who has played a major role at SOSV as an operating partner, helping our startups with business development, as well as helping close our most recent $306 million Fund 5 and our $25 million collaboration with the New Jersey Economic Development Authority. Take it away, Joe.
Hi, Sean. I never knew I'd be in front of a camera at SOSV. Thanks for that introduction. Our next session is called The Battery Wars: Can the Best Tech Win? It's technically challenging to manufacture lithium-ion EV batteries in high volumes. Just 6 incumbents, all in Asia, produce 80% of the world's supply. Several battery startups aiming to challenge the Big 6 legacy with better technology stumbled badly this year, mostly around production and technology issues. Sila Nanotechnologies, on the other hand, has raised $1.3 billion, including $375 million in June for its silicon anode batteries, which promise faster charging and greater EV ranges compared to graphite. Sila's first plant is under construction in Moses Lake, Washington. It's rough out there in battery land, and we're very lucky to have for a moderator today one of the best chroniclers of the battery biz, Steve Levine. Steve is the editor of the Electric newspaper, which is owned by The Information. Steve, over to you.
Thanks, SOSV. I'm here today with Gene Berdyshevsky, who's CEO of Sila Nanotechnologies. Gene and I have known each other for a really long time, and he's a terrific observer of his own part of the industry and the industry at large, including batteries and EV. So I'm really looking forward to this conversation. Gene, why don't we start with your business? Silicon is distinct from the rest of the next gen space in the sense that it's here. And so I wonder if you could talk about that. What are you expecting in terms of the competition? And can the West hold its own in this part of the industry versus the competition from China and from Asia generally?
Thanks, Steve. And good to talk to you again, as always. Look, I'd start by saying your observation's correct. Silicon is here. And what that means is the category shift is underway from graphite-based anodes to silicon-based anodes. That category shift will take probably 10 plus years. And there will be, more than one or two winners in that category shift. But I think 10, 15 years from now, silicon will largely have replaced graphite as the dominant anode material. And if we look at kind of the composition of batteries, 10 or 15 years from now, it'll be silicon dominant with a little bit of graphite sprinkled in. We see that kind of every day with our customers. We work with partners to replace today 60 to 80% of the graphite in a battery, which is very distinct from kind of what's happened with silicon over the last 10 years, where it's replaced 3 or 5% of the graphite in the battery. So, in general, the category shift is happening, and it's happening both here in the West. It's happening in China. There are companies that are being built. We developed technology. We invented this sort of dominant technology in silicon materials. There's different types of silicon materials you can use, but the ones that can replace most or all of the graphite are a class of materials called nanocomposites that we hold almost 200 patents around. To your question of can the West compete? Of course it can. We know how to manufacture things in the West. We haven't done it for a while. And the place to do that, the place to compete is on tomorrow's technology playing field, where everybody's starting the race from the same place. In battery cell production, where you're talking about China, Korea, Japan having had a 33-year head start now, I think it's going to be much, much more challenging. And we see that, with some of the challenges, for example, in Northvolt would have, or others. So, but in a new technology like silicon, we can and we will compete.
So, as you're talking, I'm thinking of a couple of things. Why is this important? Why do we care about this? One is that silicon gives you fast charge, and more energy density, so more driving range. But and you can talk about that. But geopolitically, I'm thinking of how cobalt got driven largely out of the battery. That's taken the edge off of our focus on the DRC.
Mm-hmm.
Graphite is one of China's greatest, in the areas where it's really dominant. Graphite is one of the ones where it's extraordinarily dominant. And over this period, you take away that one segment of dominance and replace it with another. But we need to scale up fast, right? Or China just replaces its dominance of one with this one.
That's right. I mean, we have to scale up sensibly, I think is what's really important. We have to scale up economically. We have to have a cost structure on these technologies that, is able to have long-term sustainable margins, and that means developing technology to bring the cost down. You're right, graphite is about 92% either mined, refined, or processed in China today. It's the highest concentration of any component in the lithium-ion battery. And honestly, as a result of that, even under the IRA, there are exemptions for graphite to not be included under the FIAC rules until 2026, when there are at least some kind of alternatives. And silicon does stand to be that alternative, and we have to scale fast, but we have to scale sensibly.
Yeah, I'm slightly worried about this word sensible, because does China scale up sensibly?
I mean, look, economics is like gravity at some point. If you don't make money, you go out of business. I think we are seeing, we will see over the coming years how long you can sort of defy gravity. In China, there are two electric car companies that that make money, and that's Tesla and BYD. And so, what happens to the other 100? That story can only repeat so many times before investors ultimately, there's still investors in these companies in China or in the West. And so you really do have to think through kind of the right path to getting to a sustainable business.
Yeah. So let's move on to how the U.S., how the government has sought to put the U.S. on the playing field. Most recently, we have a new round of DOE grants, $3 billion, 25 companies focused in that midstream, the processing midstream, a little bit of silicon, not much, but nickel, manganese, lithium. We've got electrolyte in there. We've got a focus on big companies this time versus the most of them were in smaller ones. And we also have right after that, one day the grants, and then the next day the U.S. announced a proposed rule to effectively ban Chinese EVs in the United States by banning Chinese connected vehicles. I'm wondering how do you view how should we think about how the U.S. is carrying out this policy?
I think, so I'll speak to the battery midstream processing, and I like the term you use, midstream. I think we get so hyper focused on the end product sometimes, whether it's the battery cell or the battery EV, and we say, well, if we just build battery factories here, everything will be fine. But if all of the input materials come from other countries, we're still dependent. And so we say, okay, we'll go one step upstream. We'll make the anodes and the cathodes here, and that's exactly what sort of the first round of the MESC grants from the DOE supported. SELA. We were fortunate to receive a $100 million grant in that, and grateful to the DOE for the support. But again, you sort of say, okay, great, you make those components. Where do the inputs to those come from? And you can keep asking this question until you get to the raw commodities you mine out of the ground. So I think this is a fairly rational sort of position to support next, the midstream. You have to also ultimately consider the upstream of where are the raw materials coming from. So I think in many ways that makes a lot of sense. You need very efficient processing of these chemicals, and if you don't have it, you're not going to be able to make the cathodes and the anodes. And then even if you make batteries here, it won't really matter from a national security and energy security standpoint. So I think that's relatively rational. I think on the connected device, on the connected components for EVs, I know less about that. I look less at sort of that seems to be coming from more of a national security angle, less of an energy policy angle. I mean, we were already imposing tariffs of, I think, 100% on Chinese EVs under the 301 tariffs that the Biden administration announced some months back. So I'm not sure that this actually plays into kind of a. I don't think this latest bit about connected vehicles has much to do with shoring up the EV supply chain.
Yeah. A couple things I'm wondering about when I thought about those two moves. I thought about tit for tat retaliation. We have seen this. There was there's a trade restriction on graphite, and there's a bar on gallium. It's harder to import that, and also when the IRA was announced, some of the components, like say LiPF6, the electrolyte salt, the price, Chinese companies dropped the price by 80% at that time, making it very, very hard for the U.S. makers of that salt to expand, which they had planned. And so I'm wondering about the reverberations of these moves. That's one thing. Could we see tit for tat reduction of Chinese prices, making it difficult for these companies? And second, in terms of the ban on connected vehicles, the sales of Tesla in China and VW and GM and Ford and everyone else have dropped. Tesla has hoped
plummeted.
Yeah. So that's a better word. Tesla has hoped to revive its sales by implementing FSD in China. I'm wondering if we get a tit for tat, whether you get China retaliating by barring FSD.
I mean, that's your guess is as good as mine, but I would say almost certainly. And and to be clear, it's the sales of foreign makers combustion cars that are plummeting in China, right? In part because you're sort of seeing the electrification transition now, where over 60% of new vehicles sold in China are EVs, and almost all of those are domestic, right? Tesla's sales are, I think, flat, but the market share is now half what it used to be just a couple of years ago, because there's so many new entrants and they're so hyper competitive. So I do think you're going to see some back and forth on this. Now, look, we work closely with Asian battery makers in Korea, in Japan, in China as well. They're building factories outside of China that need Western supply chains. And so, in our view, from a next generation technology view, it's not as simple as just, China against the West. If the battery factories are going up in the US or in Europe, and they need Western supply because that's what their customers are demanding, we want to be there to support it. Ultimately, I think that's kind of good for everybody. So I think, again, the key, I think, the focus has to be, can we build the full supply chain in the US or in North America? Can we build the full supply chain on the European continent? That's why sort of those midstream grants are so important. It's supporting the build out of that. Who builds it, I think matters to a degree, but from a security of supply, from an energy security standpoint, step one is get the factories built, and sort of go from there, right? I think what we really don't want is all of the production of all of the batteries and the upstream materials to all be in China, all of the jobs associated with that to be in China, and then the day that something goes wrong, we suddenly can't get supply. But if you have, whether it's a Korean company in the U.S. or a Japanese company in the U.S., it doesn't have to be American companies. It doesn't have to be Western companies. What you want is the supply chain to be localized. And I think that's what governments can and should focus on, and I think in large respect do. But you're right. There will certainly be some kind of retaliation, and we'll see what happens.
Gene, you raise a very good question that I wonder is going to whether it's going to end up in U.S. policy at some point, and the degree to which it will, and that's recognizing that Chinese companies do dominate the market. They make almost all of a number of big parts, like LFP, like graphite.
Graphite separators, a few other components are really dominated. That's right.
Yeah, and so if we want our car makers to compete, don't we have to allow some of those companies into the U.S. market?
I think we have to really consider it, right? I think and you see this, I think it's sort of rumors that, GM might be working with CATL and TDK, which is a Japanese conglomerate, to build a factory here. Ford obviously continuing forward with building, partnering with CATL. And some months back, we had Tesla partnering with CATL to bring some of their equipment over here for a factory that Tesla would operate. So I think we're seeing that, and I think we have to thoughtfully consider those cases. There's not a sort of one size fits all, yes or no. But I think what you want is, are those factories here and those jobs here? And then are those supply chains here? And I think what we've done sometimes is we've said, well, we just want electric vehicles. Doesn't matter what supply chain is. Well, okay, and then we just want batteries to be built here. Doesn't matter what supply chain is. I think this notion of, if your whole supply chain is based in North America, then you get the benefits of the IRA. That's the notion we should be moving to, and that will drive the best companies to compete on a level playing field in the U.S. And if they're a Chinese company that's doing great and they can build a factory more economically here in the U.S., or if it's Sila that can build a plant more economically in the U.S., let's compete. That's the nature of how we should operate. And ultimately, the American people, the American job holders win in that situation. So it's when you start sort of selecting only the end component and saying, well, as long as we get the cars, no problem. Like, that's when you start to have these issues.
Yeah. That's super interesting. Let's talk about fundraising. So a key part of getting the supply chain built up and getting is in investment. This is huge in investment. You just gone through a big fundraise. It's hard now, right? And I'm wondering, has the though the kind of investors who were investing in batteries have they moved on to something else? How should we think about that? What's it going to take, to get that money to move back?
There are definitely some investors that kind of came and went, but I would say that that's been kind of the minority of investors. More of what's really happening, Steve, is that in the private markets in particular, and at the growth stage in particular, which is where a lot of these companies are that need, 9-figure sums of capital, there's just been a freeze on the movement of money. And you can sort of trace it back to the fact that there's no M&A and there's no IPOs. There's no IPOs because the market's tough right now in the public market, but there's no M&A, in either. And so most of these investors that have committed to funds, right, the limited partners that commit billions of dollars to these funds, aren't getting any of their money back out. So they've bought a lot of assets. Nothing's returning capital, and so there's no capital to reinvest. So that's making it very difficult. Obviously, the sort of sentiment on electrification is also making it difficult, and interest rates and all the rest are also making it difficult. But I think while everybody kind of understands the sentiment bit, and frankly, most of the investors that have been here before the sort of last couple of years and are still going to be here a few years down the road, they see the sentiment as a periodic thing, right? We had a lot of hype a couple of years ago, and we have a trough. And you and I are both spent enough time in this industry to remember when this happened in the early 2010s, right? We had I remember reports from the big banks saying, 30% EV penetration by 2015, and I was like, physically not possible. So this is the second go around. The car makers know that the future is all electric. Many investors know the future is all electric. But the thing that hasn't been talked about is the sort of the freezing of the markets, that there's no M&A, that there's even mediocre kind of M&A unlocks capital to then invest in the future winners, and none of that is happening.
Okay, let's talk about we've got just a few minutes left. I wanted to talk about Tesla because it was the driver of everything we're looking at, right? I mean, China happened because of Tesla, and I'm wondering if you're worried. We didn't say you started out in Tesla. You're there at the very beginning, employee number 7. Is that correct? Yeah. So you've got that in your DNA. Are you worried about where Tesla is, where it's going? Is it still driving the market?
I think the mission in the early days was always to spur the world to go all electric, right? That was the goal. And I sort of left in 2008, and Elon since then has built Tesla into a monster of a company that was going to go and eat everybody's lunch in the automotive space when it came to the transition, right? And for many legacy automakers, at first there was a curiosity. Later it was sort of, okay, they'll it's a thing, and eventually became, oh my goodness, if we don't move, we might be out of business. And so that fear drove a lot of change in the industry and the legacy OEMs. And I think that with Tesla shifting its focus more towards autonomy and less towards electrification, I think that fear has also now shifted, but it hasn't gone away. It's just shifted to being, well, China's going to eat everybody's lunch if these car makers don't figure out how to electrify. Chinese EVs are very high quality, and the sentiment in China is, when it comes to combustion cars, you want to buy a Western brand. But when it comes to an electric car, you want to buy a Chinese brand because they're ahead. And so I think that that should be the thing that keeps folks up at night. Where it used to be Elon, it's now China if you're a legacy OEM. And yes, there's all the sort of subsidies, and you can think about tariffs and trade wars, but fundamentally, as they figure out how to make a product that's just better, it's going to be harder and harder, no matter what kind of protections you have in place to compete. And so if you're a legacy OEM, you have to be thinking, how do I make the best damn EVs in the world? Full stop.
Thanks so much, Gene, for spending this time with us. Super interesting conversation.
Thanks. Pleasure.
And thanks, SOSV. Back to you.
Thanks, Steve and Gene. That was a great tour of the battery battlefield. It's tough out there, but we're hoping that silicon anodes realize their full promise as a major step up from graphite. For our next session, let's turn to Po Bronson. Po is an SOSV general partner and the managing director of our operation in San Francisco. He's also the author of 7 best-selling books, which is pretty amazing. Over to you, Po.
Thanks so much, Sean. I'm really happy to introduce this next session because it's one of the most important at this summit, given the growing importance of major corporates to the advancement of new technologies gestating in startups. The title is CVCs, Acquisitions, and Big Corporate Climate Tech. Many global companies have pledged to decarbonize their business, and a growing number are updating investment teams as a way to find new technologies. Among the most active are tech and energy-related companies. In this panel, VCs working inside the major corporations, Shell, Siemens, and Amazon, will discuss how venture fits into corporate decarbonization strategy, how founders should engage with them, and what criteria led to investment, offtake agreements, and acquisition. Our moderator is Maya Palmer, the editor at Global Corporate Venturing, which is a media firm dedicated to covering corporate venture. She helped found the tech publication Sifted and worked as a technology correspondent for 19 years at the Financial Times. Over to you, Maya.
I want to introduce an excellent panel that we have today. because we have three corporate investors who are really quite experienced with dealing with startups at all stages, and particularly making investments into the kind of tricky area of climate tech. And more importantly than that, actually kind of trying to do something constructive with those investments once they've made, so sort of try to foster those relationships with the parent company and so on. So to get into this, I am joined by Kendra Rauschenberger from Siemens Energy Ventures, Phoebe Wang from Amazon Climate Pledge Fund, and Vikas Gupta, who's from Shell Ventures. So obviously, three really huge corporations represented here. And I wanted to kind of kick off by getting you each to kind of tell us a little bit about how you are currently engaging with startups. I think there's a lot of myth and misconception sometimes about the relationship between big corporate investors and startups. And sometimes, that there's kind of a conception that, you don't really invest in very early stage startups, and that, maybe this is just all a big lead up to an acquisition and so on. So let's kind of go through some of that myth busting. Anyway, so shall I start with you, Kendra, and just tell us a little bit about kind of what you're doing? I mean, Siemens Energy Ventures is really, really varied in how it kind of engages with startups.
Yeah, so thank you for having me go first. So when you look at who we are as a company, we are an integrated energy technology company that has its mission to really help accelerate the energy transition. Then it's been very clear that we need to find effective mechanisms to tap into the power of startups and really also provide our strength back to the startups so that we can really help commercialize and scale the technologies that are needed to get to net zero by 2050. And there's probably two things I wanna mention why this is important to us. So first of all, we know that 35% of emission reductions need to come from technologies that have not been commercialized yet. And secondly, you see disruptive technologies like Gen AI and quantum computing also starting to have an impact on how the energy systems operate today and will operate in the future. So for us, there's no question we need to be really good at working with startups to bring those innovations to life. And we basically do three things. We build our own startups. We have piloting and adoption program where we basically look to provide business impact to our business, but also at the same time help scale startups that can solve a problem for us. And that's mainly in digitalization, automation, robotics, cybersecurity, kind of tech enabling technologies that are really, really important for us as a corporate. And then we also invest into startups that can help provide sustainable, affordable and reliable energy systems. So this is more the hard tech piece where we look at specific areas that for us is important to drive our corporate strategy into new emerging technologies and how to help them scale. So that's kind of how we do things. And it's been quite successful so far. So we've been piloting with more than 80 startups with about 40% going into commercial collaborations with us. And when you look at the investment piece, currently we have 5 portfolio companies, but the way we invest is a bit different maybe than other corporates do, where we not only bring capital, but also capability to really help the commercialization and scale up and get beyond the first of a kind challenge.
Okay, great. Well, no, thanks for that kind of overview, Kendra. We'll come back and kind of dig into some of those. But I mean, what I'm taking away from that is a really high rate of actually collaboration with the startups that you're investing in. So we sort of need to come back and see how you're doing it. But would love to move on to Phoebe. So Amazon is, one of the biggest funds out there in terms of if you count together all the different things that are going on with the climate fund, the industrial fund, and so on. But what about kind of if you were to speak to startups? I mean, are they just, how do you engage in the smaller end of that? Are you just kind of getting lost when you engage with such a behemoth as Amazon?
Yeah, thanks a lot for having me over here, and honored to be on this stage. So everyone, on the Amazon Climate Pledge Fund, as many of you know, we are relatively young in terms of the years that we have been investing. But in terms of kind of companies that we are looking at, if you think about Amazon, we have over 100 subsidiaries.
So there are a lot of different needs and wants from our business units. So that ranging from like a data center, AWS, right? You have large energy requirements. You also have like construction requirements. And all those have its implications of sustainability. And then ranging over to the retail, like the .com e-commerce. And then also like 2 years ago, we have acquired MGM. So now we have Amazon Studio. So there are a lot of different needs that we need to cater for from the Climate Pledge Fund to reduce their carbon footprint. So for the companies that we engage with, we actually try to consolidate them into like 5 different areas. So that includes like mobility, transportation, and then we do like a hugely in the energy side. There's also food and agriculture because we have Whole Foods, Amazon Fresh, and then we also do like a semiconductor for the data center needs, as well as the circularity. So there are a lot of different areas that we want the startups to be able to kind of reach out to us. Now, I might have mentioned that it's kind of a huge corporate, right? One thing that we want to avoid is to have a bear hug to the startups, and because we know that startups probably only have like 10 to 100 people, where like Amazon have 1.5 million people around the world. So that is why we have our Climate Pledge team to be around and to really kind of guide the startups through the process. Internally, we also have what we call kind of CTA, and it's really kind of focusing on our portfolio companies and help them to get engaged with different business units so that they can get into that commercial agreement that they want. They want to get into the piloting opportunities and potentially testing to show that they're able to get Amazon as one of the customers. So one of the examples that we can dive deeper later would be like Rivian, right? And then we have signed 100,000 vehicles when we first invested in them. And now you see the electric van delivering your package at your doorstep. So yeah, again, very happy to be here and happy to kind of share more about how we do things in Amazon and then the CVC in general.
Yeah, no, thanks for that, Phoebe. And I think it would be fun to dive into the Rivian case a little bit in a bit, because I think it shows what a kind of incredibly powerful customer, Amazon can be, and how that can really help scale up a company. But I guess one of the questions people will have is, how do you kind of go from A to B? So that's something to dive into. But let's move just briefly on to Vikas. So thanks for joining. You're representing Big Oil here. So obviously, a company that has, a lot to achieve in terms of trying to get to those net zero targets and so on. So I'd just be kind of interested, maybe if you could give us an overview of, sort of what are you looking for and how does the company then engage with those startups that you're investing in?
Yeah, certainly. So Shell Ventures as an organization has been, I think from what I understand, the OG in the venture space, CVC space. Shell Ventures was there 1990s or so. At that time, we used to invest in the oil and gas space. But since 2012, Shell Ventures' direction has changed, and it's primarily focused on investing in decarbonization of the energy landscape. And we further look at decarbonization, to make it simple for us to understand, in 3 verticals. One is the industrial decarbonization space, which includes our own operations, our customers' operations. So this vertical includes carbon capture and sequestration, nature-based solutions, carbon trading, and other items to decarbonize industry. The second is decarbonizing transportation. So that includes electrification of ground transportation, as well as alternative fuels or sustainable aviation fuel for aviation, as well as for fuels or other options for marine transportation. In the same vertical, we have a large retail footprint. So Shell has more than 45,000 retail sites globally. So we look for innovation on how to use those sites for decarbonization as well as for revenue potential. And then the third area where Shell has embarked upon is in the power landscape. Shell has minority interests in a few solar and wind development opportunities, but at the same time, it's one of the largest traders of electrons. So we look for innovation in those areas. In terms of collaborating with startups, Shell Ventures invests across Series A to Series E and F, so pretty early to pretty late stage. We also have a fund which we call SPX that invests in very early stage, seed stage investments. Those tend to be very technology heavy, less business model innovations, but more technology innovations. And thirdly, not part of Shell Ventures, but Shell has a program called Game Changer, which also invests in very early stage innovation that impacts the energy landscape.
Yeah, okay, so it sounds like there's lots of avenues actually for even very early stage, companies to kind of, work with you even before they perhaps have that sort of scaled up business model and maybe even a product, right? So there's opportunities.
Absolutely.
Yeah. And then what about when they do have something that is sort of ready to start being used in a commercial sense? How often do you find that your startup, your portfolio companies then end up doing something with the parent corporation?
So I don't have the exact number that Kendra had. I think she mentioned 40%. I don't know what our number is, but we have a team in our ventures team, which we call the Shell Ventures Business Development Team. Every investment we make, we use them as part of the deal team to identify where in Shell that innovation could potentially be used or could help that innovation. So when we make the investment, that lens is already kind of used to justify the investment. There's a company called Exelos, which builds digital twins for wind turbines. We use them very heavily whenever we kind of bid on new projects for wind energy. That's a very strong relationship, and Shell is one of the largest customers for Exelos. This is the other example is Sonnen, which is again based in Europe. It's a residential battery storage company. Shell Energy in Europe used to use that on a regular basis to provide residential energy storage. So basically, I think if I have to guess, I would say at least 20 to 30% there's strong collaboration, and then the others, depending upon their stage, happen in the future.
So I think that's a good message really for startups that are maybe looking to take that corporate investment, is that there really is kind of, a pretty good path there for the startups to engage. I would love to turn back to Kendra now a little bit, just because I wanted to probe, again, you also have kind of multiple ways, again, for startups at different stages. So I just wondered whether you could talk a little bit about kind of a range of different things that you do, right from, accelerators and incubators, your own venture building, and so on.
Yeah. So I think when you look at particularly the investment piece, we do actually like to come in around Series A, Series B. And that's simply because we think we are a good investor at that stage, because we can bring capability once there is kind of a product that we can do something with and support the company in scaling up, particularly when it comes to first of a kind projects. But there's also many startups that we're working with that are basically not necessarily in Series A, but that provide a solution that is ready to test and pilot, where we get engaged. And the way we get engaged is really that our lead is a real problem in our business, that we have a business sponsor for that is ready to engage with the startup and also has budget actually to engage, pay for the pilots, and also take it into adoption. So I think the biggest shift we had in the last 3 years about how to make startup collaboration earlier stage also effective is to have a clear problem in the business, have a clear business case around what that solution could do to our company and our customers, and then really scout for the startups that provide those solutions. That's been super effective. That's why also I think we got the adoption rate around the 40%, which I think is quite strong for corporate like on our scale. But saying that, I think what's really, really important to us is also engage in the wider ecosystem, particularly when it's kind of pre-seed and seed companies. We are probably not going to invest at that stage. We might pilot if there's some kind of product that you can actually use. However, in that stage, it's much more important for us to actually build connections, build relationships, get to know the team. So this is where we basically collaborate with a lot of the climate tech incubators and accelerators to really understand like what's coming in the pipeline. How can we be helpful at that stage, which might not always be an investment, but which might be, coming in with a masterclass, coming in with explaining how to work with the corporate like Siemens Energy, bringing in some mentors from the business that can basically work with the founding teams to, really get unstuck on like specific topics. And I think this is value we can provide much better than investing at that stage. And I think for us it was important to realize like where's our strength, and that's why we, I guess, have a different approach on those different stages. And so far, I think it works, but we are also still learning, right? I mean, any corporate, I think, in this environment is still kind of learning how to be better and how to be easy to work with. So that's really important for us as well, to continue to become better as a partner, as an investor, and as a customer at the end of the day.
But lots of startups might not realize that it's possible to kind of have lots of stages of that relationship that don't necessarily involve any money initially kind of changing hands, but it could just be being plugged into some other kind of help, which is good. I'd love to ask you now, Phoebe, just a little bit more, because we started talking about Rivian. Can you talk us through sort of in broad strokes how that kind of relationship developed from starting point? And
yeah, so maybe I'll take Rivian as an example, but this definitely like you can apply to any of the companies, right? If you want to do a collaboration with a large corporate. So when we first look at what company that we want to invest, do we have this kind of top-down or thesis-driven? We would usually do a kind of internal inquiry to see what are the areas that has the largest CO2 debate. And we also want to see what are the technologies that can help us to get to that and what pathway that we can do. So for Rivian particularly, we know that Amazon, we have our fleets, we have our delivery. And it's also one of the top feedback that we got from the customers is that like our customers want to see us to be very forward thinking and be sustainable and contribute positively to the society. So when we were looking at that time, it was several years ago, right before the whole EV boom. So we identify like one of the companies, Rivian, as the top startups that we want to invest in, primarily for not only like they have the technology, they have really good management team, they have the talents over there, but also like they have this mentality that they are willing to work with Amazon and to cater for our needs. So there is a really good video like on our website. I would encourage people to look at it and see how the kind of the thinking behind it. But really, like when we first invested in the company, there's like startup being startups, right? They don't have huge factory, they don't have like running fleets to produce. But we have basically committed to say that we're going to acquire 100,000 of the vehicles in the coming years for Rivian to be able to deliver that and to work with Amazon to deliver our goods. And I think that has proven to be really powerful because one, having Amazon as your customer and on your customer list, right? And this is a lot of startups needed to work on basically is one, your customer pipeline, and two, your PO or purchase orders. So I think working with large companies like Amazon, like Siemens, like Shell would help you for that. And then two is like showing the willingness to work with large companies to deliver that. So we're pretty happy about the results. And I think you see Rivian cars driving around. I'm in Seattle. I see that all the time. And I think that's really positive. And right now we have over 30 companies in our portfolio. I would say like a vast majority of them have like collaborated in different forms with Amazon's business units. Many times they are collaborating with more than one, right? Because as I mentioned, we have so many different subsidiaries, different business units. Like if you're a battery storage company, if you're EV cars, if you're like aviation, even there are different business units that we can link to you or link the startups with. So that's also something that we're very proud for ourselves. And maybe lastly, I also want to mention about this kind of customer obsession, which is one of our leadership principles at Amazon. So from our fund perspective, we treat our startup CEOs and our external counterpart as our customers. So we are obsessed and delivering values to them and always thinking about how to make one, like for example, the process more streamlined, but also make their experience more meaningful working with us. And then also we want our startups learn from some of the leadership principles that have been proven to bring Amazon where we are. So we also have Amazonians in residence, where we have leaders, top leaders that have been scaling business units or businesses from 0 to 1 or 1 to 1 million, and have them help our startup founders to get through that growth stage and scale up stage.
So what happens? Do you sort of behind the scenes, are you sort of dropping people into to kind of really intensely mentor the companies? Or I think you also mentioned that you sort of have people who are guiding them in their sort of initial interactions with business units. So is that kind of all a well-honed sort of program that you kind of crank into place?
Yeah, so the main program is actually, we have an internal team that do like internal business development for our for our startups. And then out of that program, there are different toolkits that they use, right? They can help our startups with like the PR, with the marketing, and then also with kind of procurement, and then working with our internal business units. But at the same time, there's Amazonians in residence as one of the marquee program that my colleagues have been putting together. So these are like leaders, like they could be like director, vice president of Amazon that are leading the business units, and then seeing that kind of grow and have them help our startups. And obviously they're very busy. We are also mindful about their time. Startups are very busy too. So we want to make sure that this is a really good match. And then also it's a very curated discussions and have the pain point or like specific project that they're working with.
Okay, no, it's good to get the sort of inside view on that. And because I was wondering with you, I mean, again, you mentioned a couple of very successful examples of where you've gone to, work with a portfolio company. But I'm wondering whether you could speak to something which I'm sure is an issue for everybody on the panel, but just what are sort of common pain points or things that need to be you need to do some troubleshooting on when you're trying to get the startup from the stage of, okay, they're in the portfolio, they've got some investment, it looks kind of interesting, but what needs to kind of happen, or what should startups know about what needs to happen to get to that second stage of?
Yeah, I mean, we see that quite frequently. I think the biggest challenge happens is obviously startups move at a different velocity than big companies do. So their expectations on responses and getting things done are much faster than a big company like a Shell could do it. I think so. The way we've seen that the challenges have been that we want to have a collaboration. They want to sign the contract in a month. Shell has its own processes, which are justifiable because it's a big organization. So the way we try to address those is, as I mentioned, the business development team, we engage with the company much earlier, just at the investment stage. So if we know there is a collaboration agreement going to be happening imminently, we start that process early and have the right stakeholders in Shell informed about the investment that we are making, so that they can provide us the challenges that may be there for that collaboration agreement. So we address those proactively so that we find a good middle ground between the two to have those collaborations happen. Obviously, Shell's risk appetite is different from a startup's risk appetite, and we'll never be the same. But we try to find the middle ground by collaborating and enabling that collaboration.
And I think are there I think I'd sort of like to ping this over to Kendra. Really, again, it's the same sort of question, but are there any kind of common pain points that happen when you're sort of trying to prepare maybe a startup that hasn't worked with a big corporation before?
Yeah, I think there are a few actually. Often we get approached by startups who kind of know Siemens and know a little bit about Siemens Energy, but they really have not done the work to understand how their solution can be a benefit to our company. And so I think one thing that's helpful for us if startups approach us is like, do your homework, understand how we operate. If you don't know, ask before you pitch, but really make clear how you think a collaboration can actually drive a mutual benefit. I think that's one thing that was really important to us. I think the speed topic that Vikas mentioned is also something we see, right? Like, how do you manage expectations between the big corporate and the startup that just moves at different pace? We have started to rewrite some of our processes So we get to a point where we can actually issue purchase orders to startups within like 3 weeks from initial contact to we want to do a pilot. But that's because we have done a lot of work with the business to understand the problem and the business case before we even engage with the startup, right? So, but that's been really helpful, just to rewrite our own way of working to dance at the same tune. And then I think lastly, what's also important and helpful is we see a lot of startups kind of branching out to like many people inside Siemens Energy and try to get a hook in the door. Now we as a corporate have decided to run this a little bit more central to help actually the startup be faster. Because imagine if you're a startup and you try to find the right person in the company, there are so many avenues you can take. But if you actually channel this through a ventures team, that's kind of the door opener. Just like try to understand how the corporate operates and then respect those structures, because we're here to help. But it's really hard for us to help you if you're all over the place, right? And we want to make it effective. So let's be effective together. I think that's how we look at it.
And I wonder if I could address one sort of elephant in the room, really, if I can. And I'll start with you because I'm not picking on you just because you represent an oil company. But I just wanted to, the cynicism about whether big business is really, willing to change and take on these things. You're dealing with, some founders who may be very idealistic. I mean, how much do you come up against this idea of, oh, well, I don't necessarily believe that this collaboration is going to be helpful to, the startup, or if they have any reservations?
I thought that would be the case, but actually I'm surprised. I rarely come across that kind of pushback. I think everyone realizes that in the energy transition, you do need collaboration with large companies to make it happen. I actually can't think of any example where I've heard pushback that, hey, you're a big company, we don't want to talk to you. In fact, I think it's an asset that when I see something interesting and I say I'm from Shell, I get the response right away. It's actually the opposite than what you would imagine.
Okay. So in fact, I mean, it sounds like in somewhat times they just want to go faster than you're even able to. So
yeah. And I think I agree with Kendra. I think so we have offices all over the world. So quite often entrepreneurs will hit our businesses all over the world. And so we're getting the same emails from 5 different locations. And that can kind of makes us feel that they are desperate and they're doing the right job in terms of trying to find the right person. But I think they should channel their contacts to the right geography, to the right people, understand the org structure better, and that will make them more effective.
Okay. So any startup watching this presentation, just spend that 5 minutes on the website and, do some research into who you should be contacting. What about you, Phoebe? Is there ever pushback? Do you have startups who have some reservations about working with Amazon?
I haven't found that so far. I think people know that this is going to be is basically an existential problem, right? We need to have every stakeholders and every force that we can find. So I would say that so far, if we're looking at all the companies that we have been engaging, all the feedbacks are pretty positive. And that is also the reason why we have the climate pledge. It is not only Amazon, we also have almost 500 signatories, which include like HP, Unilever, P&G, large companies, as well as small companies, to march towards the common goal, which we're going to be like net zero by 2040. So that's I think everyone knows it's going to be taking everyone's effort for us to reach that goal.
And then I guess same question to you. I mean, Kendra, ever any pushback about the sort of big company aspect of this?
I don't think in collaborations we enter, we've seen this either. But I don't want to talk it away, right? I mean, there's been so many research that's been done on the fact that collaborations between corporates and startups are rarely successful. And we are quite conscious about this. So we really try to, as I said before, learn how to become a better partner, learn how to become easier to work with, learn how to tailor our process so that it actually makes sense to enter into collaborations with startups. So I think from where we are standing, I think there's a lot of potential around us, and probably there will always be startups and also business side teams where it just doesn't click, right? Because at the end of the day, it's not only the solution that we're after, but also we want to work long-term together. So there also needs to be some kind of cultural fit. And I think that happens, but in the majority, we are really, really looking forward to unleashing each other's potential and really making a big dent in the energy transition together.
Yeah, I think there's a lot of food for thought there. And I know we're coming to the close of our time, but I just wonder whether there's anything that, any final pieces of advice if somebody does want to kind of, if a startup wants to contact you, and if we whiz through really quickly, but, advice, have from anything, how to contact you or how to pitch or, if you start us off, because.
As I said, I think just look at the organization and find the right person. Ideally, I mean, even though we are corporates, I think cold calling usually doesn't work. It's best to either meet the investor in person or find somebody who knows you and get an introduction if you want to get our attention. We get inundated with too many LinkedIn requests, and then after a while, we kind of forget who had reached out from there. So that would be my advice if you want to reach out to us.
So sort of similar roles to other VC approaches, no different from that, do your research. Phoebe, any advice for someone looking to engage with Amazon?
Yeah, I think definitely do the homework, right? I think Amazon publish our kind of newsletter, and we have our blog, so definitely look into that. So I also give out a lot of information about what we are looking at and events that we're going. So feel free to kind of connect me on LinkedIn or follow me on that. And then I think the third piece is really kind of doing homework, understand how is the strategic angle for your startup with Amazon or with other corporations, and then find the right person to connect with.
And what about you, Kendra? Is there other ways where a startup can check kind of what you're, with whether they'd be a good fit for you? I mean,
yeah, I think, as my two peers are saying, there's company websites and contacts that, of course, is worth checking. I think the one thing I would say is put your startup solution into the context of a problem of the corporate or the customers of the corporate, because that, I think, makes it much more relatable and understandable why you think this is actually a good fit. And going back to Phoebe's words, do your homework. It's really, really helpful to understand the context of the problem space and then latch onto it, as opposed to just pitching the solution, because there's so many out there. I want to know, how can you help me solve a problem? And in order for you to say that, you need to understand my business. So I think that's really critical for us.
Okay, well, I think we're going to have to probably end it there, but I think I would just summarize this by saying that I think what might surprise a lot of people is just how many resources there are, in corporates and corporate venture units really to kind of help. There's a sort of relatively high attach rate in terms of the number of portfolio companies that then go on to have some kind of relationship with the corporate. So if that's what you want, this is definitely a good route to look at. And, I think as everyone on the panel has kind of indicated, there's a lot more humility and willingness to learn and willingness to kind of be adaptive to startup needs than I think is commonly understood. I think people look at large corporations and think it's this wall, this impenetrable, and that's going to come with sort of a certain amount of arrogance. I rarely find that to be the case. I think when I speak to corporate investors, they're always kind of looking at how they can make their offering really appealing. So I think there's that. But I think also on the flip side, I think as people have indicated on the panel, you do need to do a bit of research, because not everything is going to be the right fit. It might not be the right time. It might not be the right solution. And the other thing I would say, writing about corporate venturing day in, day out, is no two corporate venture units are the same. There are probably somewhere up to 2,000 in the world, and every single one of them has a slightly different, flavor of how they operate. So do a little bit of reading around. That would be my advice. But thank you very much to all of the panel for kind of illuminating that. And I hope that's been useful for everyone.
Thanks for having us.
Yeah, thank you.
that was a great conversation with some of the most sophisticated and committed corporate VCs when it comes to climate. It's so important to realize that the VCs at corporates are a key entry point for startups. As I said in my opening remarks, it's important that climate founders and VCs get better at building bridges into corporates who are actively looking to decarbonize their industries. Well, it's hard to believe day 2 of the summit is done. That went by quickly, but it was highly educational and inspirational for me, and I hope for you as well. I just want to thank Goodwin Law and Carta for sponsoring the summit. It would be hard to produce this event without their support. There are still several live breakout sessions programmed until tomorrow, and our VC founder matchmaking is also running until Friday night. There are well over 1,000 participants, and many matches have already been made. This is Sean O'Sullivan from SOSV, challenging you to go out and fight hard to win this climate war. Thanks for joining this year, and we're all looking forward to seeing you again next year.